There is a lot of appeal to U.S.-denominated assets still.
I don't think we're going to see this resurgence to buy America.
It's very hard to undo a decade of policy that's been very favorable for the U.S.
From a market perspective, anything that lowers that amount of uncertainty is positive.
Most of the gains are behind us because it still is very hard for the S&P to reach new highs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
How is it only Wednesday? Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday as the president doubles down on deals.
And with this trip, we're adding over $1 trillion more in terms of investment into our country and buying our products. There are multi-billion-dollar commercial deals with Amazon, Oracle, AMD. They're all here. Uber, Qualcomm, Johnson & Johnson, and many, many more.
President Trump clearing the way for Nvidia and AMD to sell chips to Saudi Arabia, boosting chip stocks and helping to wipe out all of the equity market losses for 2025. Attention now shifting to Washington as House Republicans push to reach a tax compromise potentially as soon as today.
Before we get to taxes, before we shift our focus yet again, I think it's fair to recognize just how rare it is to see this type of upswing in this type of period of time, let alone the period of time. It is incredibly rare for the S&P 500 to be down more than 15% and then actually climb out of that hole. It's only been done 5 times over the past span of modern history. So do people have confidence in this, or is this a head fake that is designed to really be a short squeeze and exercise the maximum amount of pain?
I think you're bullied into this if you're missing out on these gains. Over the past few weeks, we have had a positive growth shock off the back of the headlines of the past few weekends. A positive growth shock that's led to revisions in equity market price targets higher, revisions to Federal Reserve forecasts for rate cuts, pushed them out. A positive growth shock that's moved this market in a major way in the last month or so.
A positive growth shock that we didn't necessarily get the worst case scenario. And so suddenly we have long-term investors who are grappling with, okay, is this a really good thing? Or are we looking at tariffs that are still, even after the revisions, at around 16%, which is according to Yale Budget Lab, which is the highest level still going back to 1937. How do you factor that into an economy that we will not get a clear picture of potentially for as long as a year, as we were hearing about yesterday? It becomes really cloudy, and then you add to that the confusion around policy. How much can we just focus now on the tax bill and ignore all that noise?
Well, let's sit on the tax bill and let's talk about the yield curve. So the 2 years anchored around 4%. This idea that the Federal Reserve is anchored around doing nothing for the foreseeable future. Further out along the curve is starting to get really interesting again. The 30-year pushing towards 5% once more, and this time for different reasons.
If you end up with the tax bill as originally drafted, which was a real kind of a rough draft on Friday, and they've been up all night trying to get this together, and then it's going to go to the Senate and it's going to be rewritten completely. So initial estimates do have it increasing the federal deficit by about $5 trillion over the next 10 years. You would have to imagine that this supply would end up pushing yield term premium upward for this long end of the yield curve, which is one reason why people talk about 5-year, people talk about maybe 10-year. Nobody talks about 30-year premium as we're talking about that as the risk asset at a time of so much uncertainty.
The bond market in focus, the 30-year this morning, 490, 10s at 445. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as stocks erase losses for 2025. Roule of CSIS as President Trump vows to lift sanctions on Syria, and Jens Nordvig of Exante data on why this is just the start of a bear market rally for the dollar. We begin this hour with our top story. President Trump emphasizing the importance of coalition building in the Middle East. Joining us now from Dubai is Bloomberg's Jordan Fabian. Jordan, welcome to the program, sir. Yesterday, deals, and then a shift to foreign policy. What's the next leg of the trip all about?
Cementing a relationship with another U.S. partner in Qatar. This is a nation that geopolitically they've relied on to try to negotiate hostage deals with Hamas. And the president is also looking to extend that deal making to Qatar as well. There's that possibility that the Qatari royal family gives him a luxury 747 jetliner to use as Air Force One, not to mention other sales from companies like Boeing to the Qataris.
Jordan, how much does this really cement the Middle East's position as a new power broker at a time when power seems to be shifting away from other centers that have traditionally been thought of that? I'm thinking in particular of Europe.
Certainly. I mean, you look at a country like Switzerland that traditionally has served that role as a neutral broker between two nations. And to be fair, we did see that when the U.S. and China reached their tariff détente last weekend. But increasingly, the U.S. and other nations looking to Qatar to broker these deals. Controversially for a lot of U.S. policymakers, Qatar has been a client of Hamas. That's something that some Republicans, even allies of Trump, have scrutinized, say that the U.S. shouldn't have such a close relationship with a country like that. But the president is putting aside concerns about human rights, about traditional U.S. values in the search of a deal. He says, as long as you're dealing with the United States, we're going to look the other way on those other matters.
Hey, Jordan, appreciate the update. As always, Jordan Fabian there. Out of the region this morning on the latest, the next leg of the trip, a turn towards foreign policy after a big boost to chip makers in yesterday's session.
Yeah, who didn't get a boost, right? We were talking about NVIDIA, AMD, Amazon, Alphabet. We're talking even Cisco coming out with some sort of sweetener from that particular transaction, some seeming more concrete than others, but really a deal palooza over there in the Middle East.
Helped to wipe out what remained of the losses of 2025. Equity futures this morning just a little softer. Nasdaq futures down by not even 0.1%. Here's the view on Wall Street this morning. Victoria Fernandez of Crossmark writing, uncertainty is still the name of the game, but perhaps trade negotiations can begin to offer an off-ramp, with headlines providing some tailwinds to the equity markets and a steepening of the yield curve. Victoria joins us now for more. Victoria, good morning. It's good to see you.
Thanks for having me.
We're back to where we started, 2025. How much has changed, though? How different is this equity market?
Yeah, it's all about the underlying, the internal momentum that we're seeing in this market. So we had the external momentum. We've seen the S&P come and make a 20-day high. We've seen it recover, as you were talking about, in a very quick pace from the downside that there was. But what does that internal momentum look like? And it's still weak. And to me, that's the key component. We just saw this week the amount of S&P constituents making 20-day highs that are in uptrends, sectors that have been in downtrends and relative lows that are now changing to relative highs. The question is it a head fake that you mentioned a moment ago? Are we just on a 90-day pause where is the downside, the declines on the downside, is that reversing a little bit? Yes, but do we have that solid trend on the upside that we really want to see? I'm not sure we're there yet.
Well, let's talk about leadership. Where's it coming from at the moment? And how's that developed over the past few weeks?
So that's changed. And a change in leadership is one of the things that we've been wanting to see to say that this market could continue, right? So we were looking at utilities, we were looking at staples, we were looking at financials before. Now we've started to see industrials come up a little bit. Consumer discretionary is coming up. Leave out Google, leave out Meta, even though that's about 2/3 of that sector. You look at more of the entertainment component, the gaming names. That's starting to take some leadership. So you're seeing that shift, which is positive. But again, is it just because of a headline that we had over the past week, or is it going to be more fundamental?
Yesterday, John asked someone, what's on your dashboard of economic data to watch, given the fact that everyone is saying that the soft data is unreliable and the hard data is also unreliable because it's backward-looking, forward-looking, and whichever way you're looking that you would like. So how do you assess the real-time implication for the economy at a time when policy is not set? And you have a motley kind of response from corporate America, with American Eagle withdrawing its outlook, others actually upgrading what they see ahead.
Yeah, I think the soft data, hard data conversation is actually really important. Soft data really kind of telling you where the momentum is in the market, but the hard data being the confirmation of what you're seeing. And typically it's soft data that flows through to hard data. I don't think you can ignore soft data. It is out there. A lot of it is self-fulfilling. When you have consumer sentiment really low, that means the consumer is not going out and buying because they're concerned. So maybe you're not seeing it in retail sales yet, or maybe some of the hard data is really being affected by the pull forward that we saw in front of the tariffs. And so therefore it's muddled, it's a little murky, and I'm not sure we can rely on it wholeheartedly. Even the CPI report we got, people are saying, look at the last half of April where it all started moving up again. Maybe that tells us the next couple months could be a surprise.
I have to say, when we start talking about economic data at this point, my mind starts to hurt because I think about all the variables, and you could talk about even the sentiment data, the soft data, as being backward-looking because sentiment could have shifted quite considerably in the past
from day to day.
Moments, from day to day. Right. So here's this question: if you still do have tariffs at the highest level going back to 1937, sure, it's not necessarily as high as it could have been. Do we have a sense of what the ramifications are and how much has already been priced in and how much more has to go?
Yeah, I think when we talk about what's priced in, it's interesting because I think a much brighter outlook on tariffs is being completely priced in this week. And maybe that's too much. Maybe we're getting over our skis a little bit in that direction. We've heard that the market could probably take a 10% universal tariff. We heard that in the beginning. There'd be a little bit of noise, but it would be something we could handle over the long term. And I think it's interesting that that's kind of where this administration has come back to. If you look at the deal with the UK, if you look where we are with China, it says 30%, but 20% of that is actually a fentanyl component. It's the 10% that's on the tariff. So maybe that's where this administration comes back to and says we can handle that. And over a 10-year period, talking about the budget, that's about $2.25 trillion. So I think there's some math going on behind the scenes as to where these numbers end up.
Speaking of the economic data, the number 5 container carrier, Hapag-Lloyd, had this to say, estimating the boost of more than 50% to volume compared with recent weeks. The last couple of days, we've seen a huge surge of volume, and now we need to see how long that lasts. So we've had the front loading, then we had some quiet, and now we've had a boom again.
Yeah, and we heard that same kind of tone from Maersk, right? The idea that these ships are going to start going en masse because everyone's going to try to pull things in as quickly as they possibly can. Ryan Peterson of Flexport saying there is going to be a boom in deals. So how do you price that in?
There's a scramble. The Fed chair's head must be spinning.
Yes.
The president's pushing for rate cuts. The inflation data was a little bit better than expected yesterday. How much comfort can you take from that?
I don't think there's much comfort there, actually. And I think when we see the premiums go higher on the longer end of the curve, as you were talking about a moment ago, some of that is because we're just pushing cuts further out in the year, in my opinion. If I'm Powell and I'm sitting there, and he doesn't ask my opinion, but if he did, I think he's saying, look, now I've got even more uncertainty I have to deal with. Now he just pushed my decision time 90 days out with the deal he made with China. I thought I was going to be okay, July, maybe making a decision. Now I'm in August. I'm at the September meeting having to do that. So I think his job just got a little bit harder, actually.
We're looking forward to the update to the forecast in the next month or so. Victoria Fernandez of Crossmark is going to stick with us. If you're just joining us, equity futures this morning negative by about 1/10% on the S&P 500. Lots to talk about regarding the tax bill. We'll do that in just a moment with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Ahmed. Hey, Yahara.
Hi, John. On that tax bill, House Speaker Mike Johnson says a compromise on SALT could come as early as today. A proposal being debated would increase the cap from $10,000 to $30,000, phasing out for individuals who earn at least $200,000. The standoff over SALT is one of the remaining sticking points as Republicans seek to advance President Trump's tax cut bill through the House. Meanwhile, NATO allies are working on an agreement to significantly boost defense spending. Negotiators are making progress on a path to achieve 5% of GDP on defense and related spending by 2032. The agreement would mark the biggest spending increase by Western allies since the end of the Cold War. And President Trump continuing his criticism of Fed Chair Jay Powell, posting on Truth Social after yesterday's CPI data, saying no inflation and prices of gasoline, energy, groceries, and practically everything else are down. The Fed must lower the rate like Europe and China have done. What is wrong with too late Powell? That's your Bloomberg brief. John?
Yahara, thank you. The pressure is never ending. Up next on the program, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not soon. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
We'll get to that in just a moment. We'll catch up with Bloomberg's Tyler Kendall live from New York City this morning. Good morning. This equity market wiping out the losses for 2025. Positive for the year. Positive post-April 2nd. Up from the low by almost 20% on the S&P 500 in just a number of weeks. This morning, negative by 1/10% on the S&P. Likewise on the NASDAQ. Under surveillance this morning, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. House Speaker Mike Johnson saying Republicans could reach a compromise on the SALT deduction today, a main sticking point in Trump's economic package. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, let's talk about that sticking point. What does a compromise look like?
Yeah, hey, John. So at this point, the proposal that's on the table is what you outlined there. It would lift the SALT cap from $10,000 to $30,000 per individual and be phased out with income limits. But these Republicans from high-tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And for context, they came into this week saying that they wanted to see that cap lifted to $62,000. Now, we know House Speaker Mike Johnson is negotiating with them directly, and there appears to be a way out of this, which is that the tax bill currently on the table is pricing out at about $3.8 trillion. We know the House had about $4 trillion to work with, so there could be some additional room there. But of course, that would spur concerns by fiscal hawks who are looking for savings where they could. A few different areas where we could potentially see some compromise. The Speaker said that they're considering doubling the cap for married couples. That could potentially be somewhere where we could see some broad consensus. And then the other thing to watch for could be expiration date. So perhaps they will lift the cap to a higher level, but it just won't stay in for as long. John, in all of these conversations, though, important to keep in mind that these lawmakers are really digging in. These are Republicans that represent swing districts in blue states. They say that they help deliver this majority for Republicans, and this is the issue that they campaigned on.
And Tyler, nobody is sleeping in that city right now. It sounds like everybody was up all night trying to go through this draft, which sounds like a lot of fun. Now, of course, it's going to go over to the Senate if it does pass and get completely rewritten. So do we have a sense of how much House Republicans and Senate Republicans are on the same page?
Yeah, Lisa. In fact, they actually are still on the Capitol, still working through this markup. One estimate that we got is that particularly when it comes to the tax cuts, that could go into mid-afternoon. It's going to be 24 hours plus of debate. Now, both sides say that they are working together. If you listen to President Trump, he says that the White House is closely in touch with both leaders, House Speaker Mike Johnson and, of course, Senate Majority Leader John Thune. But at the end of the day, it depends on who you ask, because Senate Republicans have already signaled concerns with a few things that the House is doing, including the SALT cap, but also when it comes to those Medicaid cuts that we are expecting. The current House proposal does implement those work requirements for able-bodied adults ages 19 to 64. We know that's going to be a sticking point in the Senate. But at the same time, there's also a lot of fiscal hawks in the Senate who want to see some deeper spending cuts. So we're going to have to see how this all shakes out.
Critical for the economy, jet fuel for the economy. Tyler Kendall, thank you. With us to extend that conversation, Victoria Fernandez of Crossmark. Victoria, your view, is it both critical for the economy and jet fuel for the economy?
It is critical, I believe, for the economy. When you look at all of the elements that this administration wanted to bring together, they hit us with tariffs first, which was kind of that negative component on the economy. They need the tax component. They need the deregulation component to come in and help buffer that. Is it jet fuel? I think it's more of the buffering than the jet fuel in order to kind of bring this economy back onto solid footing, like we were talking about earlier, get those internal fundamentals going. But it really frustrates me when I hear them say they're digging their heels in on things. And because a good deal, they always say, is one where nobody's really happy. And so that's what I think we have to do here. They have to have some compromises on something, whether it's SALT, whether it's on the Social Security components, whatever it may be, the healthcare components. There has to be some kind of a compromise, and until we see that, I'm not sure we're going to get much out of it.
Well, let's focus on the composition of the agreement, if we do get one. So there is a difference, of course, between removing a potential headwind and providing a tailwind. The bulk of this bill is going to be extending current law.
Right.
What are the sweeteners that could act as that jet fuel in the years to come?
Yeah, I think some of it are the campaign promises that people are looking for to see. So the no tax on tips, right? Lowering taxes on seniors, some of that. The SALT deductions. And they're actually talking about closing loopholes, right, on pass-throughs for SALT, which they're saying is going to raise like $900 billion. Okay, well, that's great if we can see. Everyone loves a closed loophole. So if we can get some of those things done, maybe that's positive. But that's where we have to see some of these elements come in. We're seeing child tax credits getting extended. incentives for businesses in regards to building, manufacturing plants and R&D and expensing all of that. That, I think, is where you're going to get the tailwinds coming. We'll see profits increase in corporations. To me, that's saying margins are better, employment will stay well, and consumers will spend.
Maybe I'm just naturally a nervous person, but as we start talking about this, there are sort of two sides of the coin that both potentially could be really problematic for the bond market. Either you've got jet fuel that injects some sort of growth shock that is positive, but also potentially inflationary. Or on the flip side, you have essentially a less growth forward type of proposal that increases the deficit and also creates a problem for long-term bonds. So do you see it either way potentially being a risk for the bond market?
Yeah, either way, you're going to get a steepening, I think, of the bond curve, right? You're going to see that longer end go higher, in my opinion. And we talked about Powell a little bit earlier. I don't think that puts him in a great position to say, well, great, let's cut and bring the shorter end lower. So I think you're going to continue to see yields move up on the higher end. I think they'll probably stay somewhere around the 450, 460 level for now, being in kind of that trading range. But that pressure is there. It's really, Lisa, it's the credit component, right? Credit component, you look at investment grade credit, it's only out about 20 basis points on the year. High yield, obviously much further, about 250, 300 basis points out on the year. So I think they have to watch and see what happens to the credit spreads. And does that give them a signal that maybe things have gone a little bit too far?
This is important. You think that the credit side of things is the more interesting one, not the duration side that could potentially speak to the whole bond vigilante movement that could get spurred by some sort of deficit spending plan.
Well, because it's that credit component that I think is really kind of the underlying driver of what we're seeing across the board. It's what's going to tell us what can happen with earnings. Earnings is going to drive, like I said, what you see with profit margins and with employment and all of those elements that the Fed is watching and that the market responds to. So I do think we have to watch credit, although I will say over the last few months, the FX markets have been driving more than the credit markets, which isn't typically what we see, right? Credits usually are canary in the coal mine. But it's that combination, I think, of concern around credit and what's going to happen if corporations don't get the incentives that I think they're waiting on, which means we're not going to see CapEx intentions probably go higher. There's going to be some concerns there. But then you also look, we had a very poor 30-year auction. We saw yields go higher after that. What does the demand look like there? It's very much a combination of the two.
What do you think is behind those poor auctions? Because I think there's a big difference between saying we're going to have deregulation, pro-growth, pro-risk bills going through Washington, and that leads to high yields. A difference between that and people starting to worry about financing the deficit, international investors requiring a weaker dollar and higher bond yields. Which road are we going down?
Yeah. I think international investors are still there. Maybe they're not buying quite as much, but we're not seeing them really go in and sell out of their treasuries. There was this huge concern around that. We're seeing it more on the equity side. We saw in the last week of April about 15 billion move out of U.S. equities and into European equities. So we're seeing that transition there. I don't think that's it. I think it's more of a concern around the debt. I think you could have some bond vigilantes out there. And it could be people saying, wait a minute, if this is all going to happen and yields go higher because recession is now less of a concern, maybe I'll wait on the 30-year until yields are a little higher and lock that in.
So put that all together. What are you doing with bonds?
So we've actually done, and I know you hate this word, but we're doing a barbell in our strategies, and so I should whisper that over here to Lisa.
I could tell where you were going with that, the hand motions.
But I think it makes a lot of sense. That kind of belly of the curve has been the most expensive part of the curve. So you've got to do what's best for your clients, and that's buying on the short end, and then it's going out a little bit longer and locking in there. We're not going out 30 years, but we're going 7 to 10, and then buying some on the short end too. I think when we finally get easing later this year, that'll be beneficial, and we want to have cash flow for clients.
There's two words we despise even more, idiosyncratic and diversification.
Good, I didn't use either of those today.
You want to be diversified.
Yeah, diversified. Idiosyncratic. I think transitory can get thrown in there too.
Yeah, transitory belongs there too.
Short-lived, as you pointed out.
I think the list is long, right? Victoria, it's good to see you. Thank you for being here.
Appreciate
Thank you.
it.
Victoria Fernandez there of Crossmark. Up next on the programme, we'll catch up with Norman Roule of CSIS as President Trump vows to lift sanctions on Syria. Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 just about unchanged. From New York, this is Bloomberg. Wall Street absolutely scrambling to update forecasts. Big revisions following the US-China trade truce over the weekend. Upgrades to the S&P 500 from Goldman, from Exante, Wells Fargo and Chris Harvey saying this: stocks have come very far, very fast. We think that what were ceilings now become floors and expect dips to be bought. Saw some evidence of that already this morning. We were down a few tenths of 1%, and now we're almost positive. On the S&P, we're flipping to the green on the Nasdaq 100 in the last couple of moments. 3 hours away from the opening bell. Let's get you some morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. One stock that's still decisively into the green is Nvidia. Shares up 1.8%, still enjoying that afterglow of the benefit of all the deals announced at the U.S.-Saudi conference, giving Saudi more chips as the Saudi new venture looks to build out a data center, as the U.S. also considers letting the UAE have more chips from Nvidia too. Dan Ives writing a note this morning saying that it is an AI revolution for Saudi, a new market for Nvidia, especially as China continues to face restrictions. Also, one of the biggest movers for the S&P 500 pre-market is United Health. Those shares up 2.6%, but it is a bounce back from a big decline yesterday, 17% after the company completely suspended its outlook, named a new CEO. We are getting more details about that new CEO this morning, about some of the compensation that he will get: a $1 million base pay, $60 million in equity options. They were also sure to underscore that he would have security benefits as the new CEO. Finally, rounding things off this morning with a company that has also suspended its guidance for 2025. That is the retailer American Eagle. They blamed macro uncertainty, but to be clear, the first quarter, they gave a pre-update of that, looking very weak for them too. It had excess inventory, they had discounts, and again, they just had an inventory write-down too. So those shares massively under pressure this morning, down 14%, John.
Danny, thank you. I can't think of a more difficult time to try and manage your inventory through all of this over the last few months. The pandemic was the pandemic, whatever that was. This moment's been tremendously difficult for these guys.
They have to deal with not only the potential of tariffs, but also fast-moving fashion, particularly for the teenage set, which I can tell you is a very fickle bunch. But I will tell you that I do find it interesting. Some pulling their guidance, some upgrading their forecasts, like on holding. How much is execution and how much really is the macro environment?
Another update coming tomorrow. Retail sales tomorrow morning and earnings from Walmart. So look out for all of that. On our radar this morning, President Trump delivering on his promise to strike deals on his Middle East trip, clearing the way for Nvidia and AMD to sell chips to Saudi Arabia. Both of those names, Bramo, again this morning, higher in the pre-market.
Fascinating to me, the fact that, first of all, to set the stage for this trip, President Trump got rid of the so-called diffusion rule under Joe Biden, which was basically to prevent or limit the number of chips that could be sold to places like Saudi Arabia and Qatar. Now they're talking about selling a massive amount in addition to getting these contracts for the likes of NVIDIA, AMD, Global AI, Amazon, Cisco, Alphabet, OpenAI, the list goes on and on and on. Question now goes to, are there any strings attached? Is there going to be any kind of way to avoid having those sales go over to China? What are some of the details underpinning some of this, given some of the strategic discussions that have been going on in the United States with other trade negotiations as well?
What's clear, though, the president's in deal-making mode big time internationally over the past week or so, both on the chips front in the Middle East and the trade front in Geneva, with the Swiss brokering that deal between the Chinese and the United States. Scott Bessent getting that done. And that's seen this equity market unwind all of those losses we've seen over the past few weeks. Now attention turns back to Washington. And we're going to hear a lot about the tax bill in the weeks to come. The House Speaker Mike Johnson saying Republicans could reach a compromise on the SALT deduction as early as today, a breakthrough in one of the biggest sticking points in advancing President Trump's tax agenda. And then it's on to the Senate. And as you said, then it's back and forth, back and forth, back and forth, and this could be taking a while. But ultimately, they've got an aggressive timeline. They want this done by Independence Day.
And they're basically not sleeping in order to do it. The fact that they've basically been up all night in order to write and rewrite some of the details here is important. Tyler Kendall pointed to the fact that some proponents of increasing the SALT tax deduction have talked about how some of the proposals are not as expensive as people previously thought, so they can use that extra wiggle room to potentially go toward increasing the SALT tax cap. And so here's the question. Who's going to win out? The sweetener crowd or the fiscal hawks? Because that really is the battle that the market is going to be watching most closely.
Or the bond market.
Exactly.
And we've been talking about that a few times. I think you've got to pay attention to the long end of the curve. It's subtle, but we're just starting to push those levels, push back to those levels that got people nervous a month ago.
And it goes to this theory that we've talked about extensively, where if you don't necessarily have tremendous amount of growth, but also a marginal increase in the deficit, that could be the wrong kind of sell-off at the long end of the yield curve that I think a lot of people are trying to avoid.
The president celebrated defence spending just yesterday. NATO allies are working on an agreement to boost defence spending themselves in order to meet President Trump's call that they allocate 5% of GDP. Sources telling us here at Bloomberg the NATO foreign ministers will discuss the initiative this week.
And this really would boost spending for the entire region for the first time, or to the greatest levels that you've seen since the Cold War. I mean, if they were to actually go through with this, they are in discussions. Mark Rutte, who has been actually a proponent of some of these, has been instrumental in this. I am just curious how far they will go and whether this is viewed as stimulative. I know that a lot of people have been talking about this is one bullish case for Europe because they're going to be spending. Is it for a growth perspective, or is it for just some of the defense companies that have seen the biggest boost from this?
Can we just think about, though, and reflect on the difference between now and the president's first term? The sneering, the smirking, the pushback that he received when he was pushing them to spend more. And here we are, years later, and they're all getting together without him, trying to push defence spending up to 5%. Not because they're trying to bow down to the president, but because they realise he was right all along. That's a major change.
There has been a major shift, and there are these arguments, and they have some real credence that some of what President Trump is doing is pushing other regions, including Europe, to do what their economies need anyway. In this case, the backdrop of the Ukraine-Russia war really drives home the need for them to beef up some of their military resources at the same time that the U.S. is threatening more strings attached. So it's a very different reality, but you are right. This is a very different tone in these negotiations.
Huge wake-up call for the Europeans over the last several years, that's for sure. Let's stick with foreign policy. President Trump vowing to lift sanctions on Syria and ramping up pressure on Iran to strike a nuclear deal.
We are currently exploring normalizing relations with Syria's new government, as you know. I am also ordering the cessation of sanctions against Syria to give them a fresh start. I want to make a deal with Iran, but for that to happen, they cannot have a nuclear weapon.
The former senior US intelligence official Norman Roule writing the following: the president's visit reinforces the growing sense that Saudi Arabia and the UAE play an expanding role on the world stage. Norm joins us now for more. Norm, welcome to the programme, sir. I just want to pick up on that line of thinking. If that's the case, if they spend an expanding role on the global stage, Norman, at whose expense? Who is being left out?
Good morning. Well, I think their view would be no one is being left out, but rather they are playing a new role where they connect the global north, the global south, and they're able to represent voices that previously weren't heard so often. Africa, India, and the smaller countries of the world. The COP28 that took place in Abu Dhabi, I think, was a representative of this and changed many regional views. And they see that they can bring together Zelensky, Putin, President Xi, President Trump, and they can solve problems in a way that Europe is no longer able to do so.
So, Norm, let's talk about one of the problems that they tried to address yesterday, and that was Syria. What's the significance of lifting sanctions on Syria?
The significance is huge. It provides Syria with economic possibilities to restore an economy that's been shattered by years of sanctions and its own mismanagement. This decision also comes at a time when Europe is considering its own sanctions posture towards Syria. For Syria to reestablish itself in the international community, particularly in the Arab world, independent of Iran's control, it must have a viable economy. There were great celebrations throughout Syria after the president's announcement, with the credit going to the Saudi Crown Prince for making this request.
There's a good deal of skepticism, Norm, about this embrace of the Middle East and a question of how much they can fill that role that Europe used to play of being a true ally of the United States, and whether they can be relied upon over a longer period of time. From an intelligence perspective, do you think that there is some dissonance there, or do you think that the rules of the game have just completely changed in terms of who the allies are and who are not?
I think it depends on what game you're playing. I think it depends on what your targets and issues happen to be. If you care about freedom of navigation and you're looking at the Red Sea, if you're looking at the Persian Gulf or other locations, you're going to have to work with the local players, and you need to give them a capability to burden share. So the president's significant military package to the Saudis actually enhances their capability to do what we would need them to do to burden share in that area. And in many ways, this is what we did with Europe over the decades.
There is this question, Norm, about whether this is going to become a liability down the road. And there is also some concern about opening up. Yes, it's a deal palooza. And yes, you see all the tech leaders in the Middle East trying to get deals. But the prior administration was trying to limit some of the chip sales to the region. They were concerned about potentially those chips getting passed along to China and beyond. And this question of what kind of limits are we setting on these strategic areas? Do you have a sense of what kind of strings are attached around these chip sales?
Absolutely. And it's an important and valid concern that the previous and current administration share. And the Saudi and Emirati position have been clear. Tell us exactly what you want us to do to make sure this technology is protected. They have not said, this is what we'll do and you have to live with it. Rather, they have said, tell us what we need to do in terms of a security architecture, physically, in terms of access, in terms of how we use this data, this material to make sure that it does not touch your security equities. And that explanation satisfied sufficient critics within the Trump administration to make this proposal possible. And it will be transformational, not only for Saudi Arabia and the Emirates, but there will be a splashover into the region. You're going to see their engagement with India, Africa, and Europe change dramatically as a result of this.
Norm, do you think that some of the naysayers of all of this are just worrywarts? The people who are talking about the plane from Qatar to the president as being a security hazard or other types of complaints are just people who are trying to find something to gripe about? Or do you think there's anything legitimate here?
No, the world is filled with people who like to gripe, and there are plenty of legitimate criticisms in the world. I'll leave it to others to talk about whether or not this plane is a legitimate gift or not. But in terms of what we would do in a security sense, we have more than sufficient technical capability to ensure that if a plane like that were to come to the United States, that we would be able to make sure that it is not a security threat to the United States. It would be stripped and rebuilt in many ways to have equipment placed in it so that it could be used. So it's not going to be a security threat once it's looked at. But as to the appropriateness of its acquisition, that's for others to talk about.
Norm, since we're dealing with worries, can we just finish where we started and address one significant worry? Who is this individual running Syria right now? We understand his role in overthrowing Assad, and we understand that Assad was backed by the Russians and the Iranians to some extent as well. But is being the enemy of my enemy's friend sufficient to make you a trustworthy partner in the region?
Individuals who have dealt closely with the president of Syria state that he seems sincere in his desire to be a president of Syria, that he is driven not by his previous associations with al-Nusra, an affiliate of al-Qaeda, but rather of a desire for a unified Syria. His approach to handling the Kurdish issue and some of the other ethnic elements of Syria is reassuring, but the proof is going to be in the behavior going forward. And the fact that the president is talking about lifting sanctions doesn't mean sanctions can't be placed in the future if that behavior is reversed.
Without a doubt. One to watch. Norman, thank you, sir, for your thoughtful responses, as always. Norman Roule there of CSIS. Things are so busy on the foreign policy front, we didn't even get to Ukraine. And the potential for a significant meeting taking place in Turkey tomorrow.
Yeah, this might be the first meeting since the real conflict began in Turkey between Zelensky and Vladimir Putin. I know that Zelensky has talked about President Trump possibly stopping by to say hello and popping in. You raise a good question, though, about the Syrian president and this question of, do you give a chance? Do you not? What do we know? At the same time, how do you support an economy that's been flat on its back at a time where potentially it's getting a new start?
Things are delicate there. They always are. Equity futures this morning just about unchanged on the S&P with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Israeli Prime Minister Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job. Hamas this week released the last surviving U.S.-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. Meanwhile, Burberry shares are rising nearly 16% in London trading, the company announcing plans to cut as many as 1,700 jobs, representing about 18% of its global workforce. The cuts will amount to an additional savings of $80 million in the next 2 years. The announcement also comes as the company reported better than expected comparable retail sales in the fourth quarter. And hundreds of Starbucks workers have walked off the job to protest a new dress code which requires baristas to wear solid black tops. Starbucks Workers United represents staff at about 570 of the 10,000 company-run U.S. stores. It's filed a complaint saying dress code changes during contract talks are unlawful. That's your Bloomberg Brief. John?
Yahara, thank you. Going to leave that there.
Really?
Yeah, I'm
wow,
not going
I'm
there.
impressed. That's seriously restraining.
I'm being very, very disciplined this morning. Up next, a turning point for the US dollar.
Fiscal deficits still being high, likely the trade deficits being high. That on balance, I think, means the dollar is likely to be on something of a weakening trend.
Jens Nordvig of Exante Data joins us next. Looking forward to this one from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Equity futures this morning, just about unchanged, stable at the moment on the S&P 500. A raise in losses from early this morning. We were down about 0.1% or 2. We're now unchanged on both the S&P and on the Nasdaq 100. We're positive by almost 0.1%. Under surveillance this morning, a turning point for the US dollar.
The reality is, the dollar is at the center of the global financial system. That is an extremely sticky phenomenon that's been a part of our backdrop for decades. You see the likelihood of ongoing twin deficits, those fiscal deficits still being high, likely the trade deficits being high. That on balance, I think, means the dollar is likely to be on something of a weakening trend.
So here's the latest this morning. The dollar sliding as traders weigh a potential new focus for the White House. A person familiar with the matter telling Bloomberg the US and South Korea discussed currency policies earlier this month and agreed to continue talks. Jens Nordvig of Exante Data has been bearish on the dollar for months and writes the following. It's likely that we're at a multi-year turning point. I think the dollar should be moving substantially. Jens joins us now for more. Jens, good to see you, sir.
Good morning.
It's been too long. Thanks for dropping by. We've got some time to work through this. You're looking at potentially a system-level shock that leads to a strategic reallocation of the US dollar away from the US dollar to other currencies. Can you just set the scene for us from 35,000 feet, what you think's happening here?
We've really been on a strong dollar trend since the summer of 2014, right? So we've had this incredible run in US equities. We've had US yields that were generally higher than other places around the world. And investors from Europe to Canada, Australia, Japan have been very comfortable building up really big allocations to the US, unprecedented high allocations, right? And now we're coming into this year, a lot of people were expecting, Trump 2 is going to smell a bit like Trump 1. People actually added aggressively to their equity exposure into this year, right? And then it has turned out that Trump 2 was not really anything like Trump 1. And a lot of people are rethinking those allocations. And it's not just about the tariffs, right? It's about what's happening with foreign policy, who are allies, what's the NATO arrangement going to be. There's a whole host of issues, right, that means that a lot of people are thinking about, is it really prudent, as somebody who's allocating globally, to have such incredible overweight in the United States? So I'm not talking about is the reserve currency status going to disappear. We're talking about people who have been very, very overweight. Are they going to do some risk management and take the allocation down? And I think the feedback we get from speaking to chief investment officers all around the world is that it takes a lot to shock them, but they are shocked, and they want to change their allocations.
To your point, this has been building for a decade plus of dollar longs building across all asset classes. What we're trying to understand now is, as we take some of the air out of that trade, what are the policies that you see that make the shift away from the US dollar sustainable, durable, beyond just the chaos of the last month or so? How do you think about that at the moment? And do you consider them a push dynamic, bad policies in the US pushing capital out, or a pull dynamic, better policies elsewhere sucking capital in? Which one is it?
Yeah, so the first thing I would say is that we have a list of US policy shocks. And that list of policy shocks is actually generating policy shocks elsewhere, right? So in Europe, we've had now a historical change in fiscal policy where essentially the fiscal rules have been rewritten, right? The rules that underpin the euro have now been changed in a way where you can invest more effectively, right? That's a big change. So That's important for the growth outlook in Europe. We just talked about, as you mentioned, right, the NATO budget potentially also totally different, right? 5% numbers. We used to talk about whether we can get to 2, right? So big changes. So that's something that underpins this idea that there are other places, because if you have more investment in Europe, you also have more bond issuance, right? So the whole supply and demand dynamic is changing. It used to be the case that there was actually very few assets to buy in Europe, and that's changing too. If you look at the comparison between international investors and US investors, in the US, you have an incredible home bias. That's the other part of the story, right? If you look at all ETFs that are issued in fixed income in the US, 1.7 trillion, there's only 0.5% that has any foreign currency exposure. So it can only go one way from here. That's not going to be quick, but over time it will happen.
There's an important point here. You said that this isn't necessarily the loss of the dollar as being a reserve currency. This is just simply a normalization and diversifying away from the dollar. Some people might say that this is a feature, not a bug, of this administration, that they want a weaker dollar in order to increase exports. And actually, we're going to see this increasingly as a part of policy, not just as a potential consequence.
Yeah, I think you're right. We certainly have people within the cabinet, Scott Bessent included, right, that have a different nuance to dollar policy compared to the past. There's always this focus on, okay, how do we insource some manufacturing, and a weaker dollar certainly would be helpful in that regard. And you're right. I think if you look at the price action today, it is influenced by these let's call it Bloomberg headlines about Korea trade deals, so and currency deals. So there's an element of that. So nobody's going to be fighting this trend if the dollar is going gradually weaker.
How much more weakness is there? And potentially, do you see the euro as the biggest winner?
So again, we've literally been going in one direction for 11 years on a trend basis, right? So we've just started. And if we have a big asset allocation shift, it's something that can play out over a 6 to 9 month horizon. And we can easily have, a 5% move down in the dollar index, right? And then we get to these questions, okay, is it going to be orderly, or could there be something that's more dramatic, right? And what we had in April, I have never seen. I've been doing currency analysis since 2000, effectively, right? What we saw in April, we have never seen before, right? Where U.S. bonds are selling off, equity is selling off, and the dollar trades down. So I think that was only for not that many trading sessions, but it's still a warning sign that that can happen, right? So I am, in addition to what we just spoke about, I think there's some additional tail risk that if the budget process is not one that investors are comfortable with, I worry that we can have some of the same dynamics as we had in April. So that wouldn't be my central case, but the people who are involved in these budget negotiations have to remember what happened in April. The U.S. bond market is not a kind of indisputable safe haven anymore.
Yeah.
And what happens with the budget is absolutely going to matter.
There's evidence that spooked not only investors, but also the White House in the last month as well.
Yeah, you said yesterday, who's the bigger arbiter, Republicans or the bond market? And I think a lot of people are watching the bond market very closely.
Based on this conversation, it might be the bond market. Jens, good to see you, sir. It's been too long. Thanks for dropping by. Jens Nordvig there of Exante Data. Up next on the programme, Wei Li of BlackRock, Tobin of Wolfe Research, Holly O'Neill of Bank of America, and the former New York Fed President, Bill Dudley. From New York, the second hour of Bloomberg Surveillance. Up next.
It's really hard to get a true economic read.
It sounds like there's a lot going on under the hood.
Potentially, there's more growth worries priced in the U.S. than elsewhere.
The risk of recession is receding here.
If there's still uncertainty on the other side of that bad data, it's very hard to sort of look through that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The president just touching down in Doha. We'll get you an update from Annmarie in just a moment as we commence the second hour of Bloomberg Surveillance. Good morning to you all. Your scores look like this on the S&P 500. Equity futures totally unchanged this morning on the S&P, slightly positive on the Nasdaq. A quiet session today, a busy one tomorrow. Tomorrow, you'll hear from Chairman Powell. You'll see retail sales and you'll get an update from Walmart as well. Look out for all of that. Our heads are still spinning here at Bloomberg. What a year it's been so far. Year to date on the S&P 500, we are now positive, up on the year. We dropped almost 20% from the highs. We've rallied more than 18% from the lows. This has been vicious. It's been fast.
And it's been rare. This typically does not happen. Just to put this into perspective, I keep going back to this. Bespoke Investment Group came out with the statistic showing only 5 times in modern history have we seen this kind of retracement of a more than 15% loss in 1 year. So it raises this question, is this the start of something bigger, or is this a sort of knee-jerk response to headlines that potentially could change at any moment when we're staring into the black box of data that's messy and a Fed chair who's telling us just wait and see, and wait and see.
We've heard all these comparisons to the pandemic. It's not the pandemic. And we said repeatedly on this program, the biggest difference is the president can turn the virus on and off whenever he likes. And over the weekend, he turned it off again.
There seemed to be a real sea change when it came to the relationship between the U.S. and China. The fact that tariffs were brought down, the pause period, and suddenly there was not a goal of decoupling fully. I think that phrase really changed the game for a lot of people. Suddenly, there were the contours of the rules of a new game. That more broadly, these two economies, the biggest in the world, are interconnected, but in a couple of key areas, there are going to be greater disputes. Of course, the problem with this is the world doesn't stay on hold for 90 days. And we see the Chinese leader Xi Jinping heading over to Latin America, trying to strike deals over there, criticizing the UK-US trade relationship. So this story isn't written yet, but for now, the temperature has been turned way down and people are celebrating.
The mood music has changed, that's for sure, in this market. The focus shifting once again. This time, it's shifting towards tax policy. We'll get you an update on that as well in the next 20 minutes or so. Equity futures just turning positive on the S&P 500. We're up by 0.1%, turning positive on the year as well. We'll catch up with Wei Li of BlackRock in just a moment. We'll also speak to Holly O'Neill of Bank of America on the state of the US consumer. And we'll get you an update from the former New York Fed President Bill Dudley on why the Fed's problems aren't over. We begin this hour with our top story. President Trump in the Middle East, emphasizing the importance of coalition building. Annmarie just landing in Doha, head of the president, and she joins us now for more. MH, welcome to the program. Welcome back. Give us an update on what you're expecting today, and please take some time to reflect on what we heard just yesterday.
Well, really yesterday, Jonathan, I think wanted to highlight this administration, the economic relationship, the deals the president was able to put over the finish line. A lot of that we need to make sure we're tracking because it's big numbers. Do they actually come to fruition? That's what we're going to be keeping an eye on. Things like AI data centers, advanced technology, those chips that Saudi Arabia, UAE now going to be able to get their hands on. Really a transformation of a lot of these economies that have been traditionally economies. They're able to exert their influence due to the price of oil and gas. The president is now really shifting towards foreign policy. And what better place to do that than Doha? Whether or not as the Trump administration or the Biden administration, Doha and Qatar has served as this mediator when it comes to talks in Gaza, when it came to the fall of Kabul and Afghanistan. The Qataris have seen as a place where they want to step in and try to mediate. So we do have the past few weeks, as soon as yesterday, we had negotiators here from Israel. Of course, this is where Hamas's political office is, as well as American officials are here trying to get some sort of ceasefire agreement when it comes to Gaza. And we should also reflect on what happened this morning. The president this morning met with the new Syrian leader for 33 minutes. And then he came out and talked about the fact that maybe we're going to have new relationships, normalized ties with Syria. This comes after yesterday. The president talked about a cessation of sanctions on Syria. And I'm getting mixed messages from Washington, D.C. There's some people who say, why do you continue to keep a country in chains due to the actions of the previous regimes? And there are others who are skeptic about al-Sharaa and obviously his ties in the past as a militant leader in al-Qaeda. But as Norm Roule said in the last hour, he was talking about the fact that they do think this is someone that the administration sees as he wants to turn over a new leaf. The Arab world erupted in that room yesterday because they want to make sure Syria stays within the Arab world and is not leaning towards Iran.
It's a sea change in the region. Annmarie, appreciate the update. Stay close. Anne-Marie's going to go off and do some reporting, and if we get any headlines for you, We'll bring them to you. It's been a big move, both for the broader market and for chip stocks specifically. That deal for AMD, for NVIDIA, looking for new markets when they've been effectively closed off by the Chinese and the US and their fight that continues.
This really is the key point. How much do the sales in the Middle East really offset the lack of sales that you get over to China, given the fact that there will be that strategic decoupling that Treasury Secretary Scott Bessent talked about?
Let's get you the view on Wall Street. This from Wei Li of BlackRock, writing the following. We still see tariffs causing further contractions in quarterly activity, but the cumulative impact may be more limited. We stay risk on. Wei joins us now for more. Wei, good morning.
Good morning.
Can I pick up on that line? The cumulative impact. How are you measuring that?
Well, there are two potential templates that we can mirror what's happening right now. One is COVID, the pandemic. You switch off and you switch on. But in your case, you're saying that you can switch off again and switch on again. But we're talking about kind of being able to switch it back on quite quickly. The other template is Brexit, where you have multiple kind of years of cumulative scarring, where you have the economy below trend even today. So right now, given how quickly we have seen walk back, maybe the COVID type of template is appropriate in terms of structural scarring, but we're already seeing some sort of contraction, and I think technical contraction in the future is not off the cards, it's not off the table, but chances have been lessened because of the immutable law seemingly at work to guide the destination of where we end up.
When you say we stay risk on, what does that mean in today's market?
It means positive on U.S. equities and corporates in terms of credit over U.S. government bonds. I think what we have seen so far this year, especially this week, is that greater uncertainty doesn't mean greater certainty of a bad outcome. People make false equivalence between the two, but there's a huge difference. So when we talk about kind of U.S. debt arithmetics, when we talk about supply chain dependency, this will govern how quickly decoupling can happen, if at all, which is why we were able to stay risk on despite elevated uncertainty in terms of policy making. I would also say, we talk about U.S. equities recovering year to date. U.S. equities more than recovering the drawdown since April the 2nd. But U.S. government bonds haven't. Term premium went from 35 basis points on April 2nd to 70 basis points. Dollar hasn't recovered fully. So there is something more exceptional about U.S. equities and U.S. corporates, and this is what we are focused on in terms of our risk-on strategy.
This is something a number of people have put up, have talked about, the fact that U.S. exceptionalism still lies with U.S. big tech, and it still lies with some of the mega trends as you've put them out there. It doesn't lie necessarily with the dollar and U.S. assets per se, just by virtue of the U.S.'s position in the world. I want to stick with tech. This has been a bet of yours and the sort of structural theme. Just on a tactical level, has the rally already taken back all of the bullishness that you feel? And for now, it feels like maybe it's going to take a breather, even with some of these deals going on in the Middle East?
Well, tech has taken the brunt of market correction since beginning of the year. We think that there is more to go. If you look at their guidance, they have all committed to their previous capex spend, if not increasing. Broadly, companies are guiding down their capex expectations, but for hyperscalers, they continue to be all in on AI transformation, and multiples now look a bit more attractive compared to compared to before the sell-off, right? So we do think that there is more to go. Now, the bigger picture, we talked about the walk back and how markets are kind of jumping on incremental positive development. But the bigger picture is that we're still talking about a landing zone or for U.S. effective tariffs, somewhere between 10 to 15%. That is still 5 times more than the levels at the beginning of the year. Everything considered, we're still talking about an environment where we have higher tariffs, potentially lower growth because of that, and potentially higher inflation because of that. So I think that big picture is important to bear in mind as we think about portfolio construction. And I think markets jumping just to incremental positive news development is a typical case of behavior buyers of anchoring. We just look at kind of the incremental pieces, but the big picture has, tariff represents a stagflationary shock, and we still have higher tariffs compared to before.
Which speaks to sort of the divergence between tech exceptionalism and the rest of the universe. And I just wonder how pressured the rest of the universe of stocks you see as really feeling, especially if you do see potential risk to government bond markets going forward.
which is why we definitely prefer tech and financials that have been leading in the latest earnings season compared to the rest of the market, compared to small caps, for example. So we see tech as the drivers of U.S. exceptionalism in terms of U.S. corporates, and maybe the rest of the markets as passengers of U.S. exceptionalism wave. And especially at times like this, where we're still talking about higher rates, high for longer, central banks not able to come to the rescue of the economy as they were before, we still want to focus on companies that can grow their margin, that can grow their profitability. And if you look at the latest earnings season and also previously, tech and financials remain those sectors that we want to focus on.
What happened to the European trade? Where is it now?
Well, we closed the European underweight to lean into the European trade, but we're just neutral, not positive.
What's holding you back still?
What's holding us back? Well, what we have seen so far, if you look at the rally back from the lows post April 2nd, is that the outperformance of Europe over US has stopped. US started catching up now. And if you look at the hoops that Merz has to jump through to get confirmed, there remains risks around implementation of all these ambitious policies and reform targets. So we do want to see more kind of clarity around the ambitious targets for us to be positive across the board. But we have liked European financials for a long time that have been outperforming. We also see opportunities in defense as a sector, given the future spend and lack of capacity in that space. So being selective on European equities, definitely seeing a lot more opportunities compared to the beginning of the year. But the market has come a long way. So I think one thing that we have seen so far is reversal strategy as a near-term way of navigating market volatility has worked, and right now reversal strategy seems to support US.
There's this reason why people are sort of saying pause to Europe. Just want to finish up with China. Do you think that there is more to go there, given the fact that seems like there isn't a full-scale decoupling, and it does appear to be supported by some fiscal as well?
Well, we're also selective in China. We're neutral more broadly across the Chinese equity market, but we like technology in China because of the innovation potential, as well as China tech potentially going a bit more globally. And we also like financials in China because of the national team's support, as well as funds closing their underweight. But the reaction of Chinese markets to the latest development has been somewhat mixed, because the more we see kind of progress on the trade front, the less likelihood there is for more support on the policy side to come through. So now there is definitely a positive momentum in that previously people are talking about maybe 3 handle for Chinese growth this year because of the tariffs implication. But now people are very quickly upgrading their forecast for Chinese growth this year. So selectively opportunistic and positive on Chinese equities is our near-term tactical view. But over the longer-term structural constraints around kind of aging population, lower growth, that hasn't changed.
So those estimates revised higher to closer to 5% already this week. Well, it's good to see you, as always. Thanks for dropping by.
Thanks.
Wei Li there of BlackRock. Equity futures on the S&P turning positive, higher by a little more than 0.1%, with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Not positive. Our shares of American Eagle Outfitters, those are down 12.5% in the pre-market. In a preliminary earnings release, the company said it expects revenue to be down nearly 5% compared to a year ago. The retail clothing chain also pulled its guidance for the full year due to, quote, macro uncertainty. Meanwhile, Jaguar Land Rover has joined other car makers in withholding profit guidance due to the uncertainty caused by President Trump's tariffs. The British auto giant, owned by India's Tata Motors, says it's evaluating the impact of global challenges and will provide an update during next month's Investor Day. And trading and investment platform eToro has raised nearly $620 million in an upsized IPO. According to a statement, the Israel-based company sold nearly 12 million shares at $52 per share. The pricing marks a major rebound after eToro had paused its listing last month amid tariff-related volatility. eToro shares are expected to trade on the Nasdaq under the symbol ETOR. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, jet fuel for the U.S. economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
Up next on the program, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. The president in yesterday's session, the Fed must lower rates. He won't like what he's hearing. On Wall Street, a lot of banks, Citi, Barclays, JP Morgan, pushing back their call for the first rate cut. Goldman going all the way back to December from the summer for that first rate cut for 2025 from this Federal Reserve. This market, though, not interested in that. This market interested in deals in the Middle East for chip makers. This market interested in a trade truce between the US and China. Equity futures up again this morning. On the Nasdaq by 1/3 of 1%. On the S&P by more than 1/10 of 1%. Under surveillance this morning, jet fuel for the US economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. The House Speaker, Mike Johnson, working to get President Trump's big, beautiful bill over the finish line. Johnson suggesting that Republican lawmakers will likely reach a deal on the SALT cap today. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back to the program. Just describe what that compromise might look like.
Yeah, hey, John. Well, it's going to depend on a few things. The current proposal on the table would lift the SALT cap from $10,000 to $30,000, phased out with income limits. But these Republicans from these high tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And they're threatening to sink the entire reconciliation package over this one issue. For context, they came into this week looking for that cap to land somewhere closer to about $62,000. So there's a pretty big gap there. But there does appear to be a way out of this, which is that the House tax bill is currently pricing in at about $3.8 trillion. We know that House Republicans were given about $4 trillion to work with here, which would suggest that there's perhaps $200 billion worth of wiggle room. But at the same time, fiscal hawks, of course, have been trying to find savings where they can. There's a few different areas to look out for some other compromises when it comes to SALT. Perhaps we could see a doubling of the cap when it comes to married couples. That's something that would be considered widely popular. And then another thing is expiration dates. So perhaps they will lift that cap higher, but then it just won't stay on for so long. The one thing important to keep in mind here, though, is that these Republicans really do have leverage because House Speaker Mike Johnson has such a slim majority. And, John, these are Republicans that represent battleground districts in blue states, and they say they're really digging in.
They've got to fulfill a promise, that's for sure. Tyler, thank you. Tyler Kendall with the latest down in Washington, D.C. They've got an aggressive timeline as well. Tobin Marcus of Wolfe Research writes this: despite a bumpy road ahead, we still expect the final bill will be enacted by July. Tobin joins us now for more. Tobin, welcome back. It's good to see you. Let's get to that aggressive timeline. What gives you the confidence we can get this all done, wrapped up, passed by July?
So there's a very hard deadline at the end of July, which is the twin occurrences of the August recess, when these guys are going to be out of town for an entire month. They tend to be very keen about getting out of town. And even more importantly, the debt ceiling X date, which is likely going to fall sometime in August. That is a quite immovable deadline, as opposed to some of the symbolic or aspirational deadlines around getting it done by this recess or that recess. So July 4th, as Speaker Johnson is alluding to, I think is ambitious, but not totally unrealistic. The end of July, I think, is a harder stop.
So, Tobin, what does this bill look like if they do get it done in your timeline, and how widespreading is it with respect to getting some of the campaign promises implemented?
I think they're going to be able to deliver on some version of most or all of President Trump's main campaign promises. They have in here now short-term versions of no tax on tips, no tax on overtime, something that checks the box on no tax on Social Security, although it's not exactly that. On the business side, we're going to get bonus depreciation, R&D expensing. They have this new structures expensing provision that kind of has supplanted the original idea for a 15% reduction of the corporate rate on U.S. production. So I think they're going to be able to check the box on much of that. The harder questions are on the offset side. Still ongoing debates about Medicaid. They put in quite sweeping, though gradual rollback of IRA that, in line with our views, looks like it's been pretty tolerable for markets. But it does seem like the pieces are falling into place on most of what they set out to do.
Tobin, what have we learned in terms of just how much, as Annmarie would say if she were here, President Trump is sort of chief whip? He is the one going around and getting people to support and line up behind this bill. Do we have a sense that clutch is still very much present?
They haven't really needed him yet in that closer role in the House process. I think they probably still will. We are still seeing, simmering concern about Medicaid, for example, from both the moderates and the conservatives. I think that they may need to bring him in to lead on one or both of those groups of folks. For example, if they do take the SALT numbers up to appease those blue state members, that's going to make the deficit situation look a little bit worse. There are already concerns about that on the conservative side. So I think if you're trying to get those folks on board, keep them in line as the bill gets a little bit less fiscally responsible, that I think is going to be an important role for the president.
It's open. We know a lot about the SALT lobby. We've talked about them tons over the past few weeks. Who are the hawks in the Senate that we need to focus on in the weeks to come?
So from a spending perspective, Ron Johnson has kind of put himself out there along with Rand Paul, who I think most folks are figuring are not going to end up voting for it, Senator Paul, as saying, we need more spending cuts. This needs to be a more fiscally responsible bill. I think those were points well taken because a lot of the strategy for managing the cost of the bill is to rely on timing gimmicks. So both those individual and corporate tax cuts that I was running through, most of those expire in 2028 or 29. By our reckoning, extending those for the full decade, as we all expect that they will try to do, adds another $1.2 trillion in cost to the bill. So quite substantial. This is not really a bill that tackles the deficit, and it's stimulative in the early years. And then they're also going to be pinched on the moderate side. Senators Collins, Murkowski, Hawley have all raised concerns about the Medicaid reduction. There are various folks, including Senator Capito in West Virginia, who've been concerned about how far some of the IRA rollback provisions go. So, as in the House, I think there are going to be a lot of different vectors of concern and people nibbling on different axes.
Tobin, just before you go, we're getting live pictures of the president disembarking Air Force One. He's just touched down in Doha. Foreign policy has become increasingly a focus of this trip to the Middle East. Tobin, all these promises over foreign policy deals, can you talk to us about defense spending? Just how big is that push going to be? Where are the cuts?
So, the answer to where are the cuts in general on all of this, I don't think that the deficit is really going to be a focus to the extent that some of the rhetoric would suggest. The president's budget proposal calls for, sort of flat discretionary defense funding, a big tranche of defense funding through this reconciliation bill, and then big cuts in non-defense discretionary spending. I don't think they're going to get non-defense cuts. That needs to be done on a bipartisan basis, and they're not going to have the votes for that. So I think mostly we're looking at, kind of flattish funding, along with this big new infusion of defense funding in the reconciliation bill. Deficits are not going down. They're not going to hit Secretary of Defense's 3% target. Mostly they're going to deliver on their other policy priorities and let the fiscal picture shake out where it does.
Tobin Marcus of Wolfe Research. Tobin, thank you. Those pictures coming live from Doha as the president takes the next leg of his trip in the Middle East. The next leg focusing on potentially foreign policy and more.
Which potentially could be the next leg upward if there are some deals struck, in particular the war with Ukraine and Russia.
Futures right now positive by 0.2%. Up next, we'll get you a read on the U.S. consumer with Holly O'Neill, the president of retail banking at Bank of America. From New York, this is Bloomberg. Nvidia up again in the pre-market, this time by more than 3%. Just adding some weight to this rally, adding some weight to a major rally off the low. The closing low on April 8th. We're up by more than 24% since then on the Nasdaq 100. The Nasdaq 100 this morning positive by 0.4%. The S&P up by a quarter. With 2 hours until the opening bell, with your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, I got to say, it's not just Nvidia. It's really any of these AI companies that have had a whiff of a mention in U.S. and Saudi deals. Supermicro Computer, one of the biggest beneficiaries of that. It's up 16% pre-market. It was also up 16% yesterday. The gains keep on coming. For this company, it specifically struck a deal with a Saudi data center company called DataVolt, saying it would be a multi-year partnership, that Supermicro would help supply some of the servers offers for it. The company has been struggling, so this is a big turnaround for them. We also had some sell-side action, specifically coming from Morgan Stanley, that seems to be shaking things up this morning. It gave a double downgrade of CBOE, saying that normalized relationships, or at least thawing of the tensions between U.S. and China, happened bigger and sooner than they expected. So defensive stocks that did well during the market turmoil, i.e. an exchange that does better when volatility and options are being traded, now isn't going to do as well. So they have downgraded CBOE, those shares falling 1.5%. Now, for a very similar reason, those analysts at Morgan Stanley also upgraded KKR. A more normalized capital markets environment means that private capital can do well, that deals will be getting done, one hopes, in a more normalized macro environment. Those shares up 1.8%, also saying that it's an attractive entry point considering that those shares have sold off this year, John.
Hey, Danny, thank you. Appreciate the update. Just an update on our programming tomorrow morning. Jim Zelter of Apollo. Jim Zelter a number of weeks ago talked about so-called macro paralysis. And I wonder about that macro paralysis theme now after the events of the past week.
Is it macro deal making? Is it essentially the paralysis released, cured, as people try to get to the playing field and really strike up some deals?
Look out for that interview tomorrow morning around 7 a.m. Eastern Time. On our radar this morning, President Donald Trump landing in Doha for the next leg of his trip to the Middle East. Trump expected to participate in a Qatari state dinner later on today, and that destination is playing a bigger and bigger role. You talked about it in foreign policy.
Yeah, especially given what's going on with Israel and Gaza and what they've done in terms of negotiating some of the release of hostages. On the way there, how much is he going to make a stopover in Turkey at the same time to really discuss what's been happening between Ukraine and Russia and brokering a meeting between the two leaders? Here's a question. How much does this really solidify this region's instrumental role, both on a foreign policy level, but also in an investment policy? And you pointed to the fact that tech stocks are surging and they're taking another leg higher pretty much across the board, partly because it is clear that there isn't the same kind of discrimination against some of the more friendly nations when it comes to chip sales as there is to, say, China.
I'm pleased you brought up Turkey. I think that's potentially an important meeting tomorrow. As far as I'm aware, we still don't know who's in the Russian delegation. And I think I get the sense, and others do too, that who is in the Russian delegation will dictate whether the president actually goes to Turkey to be a part of these talks or not.
If it's Vladimir Putin, yes. If it's not,
something
no.
like that.
Something
like
very
that.
similar, very simple kind of cheat sheet. That's kind of what people are looking at. It is going to be curious to see how serious these talks actually are about ending that conflict that has killed so many people.
It's been depressing. Awful, that's for sure. Elsewhere, we've got to return to the markets and talk about what's happening here stateside. Equity futures, as Lisa indicated, are near session highs off the back of these moves that we've seen in chips. But one thing that hasn't fully recovered is the US dollar. If you notice, the South Korean won has been climbing. Sources telling us here at Bloomberg that South Korea and the US discussed currency policies early this month in Milan, with an agreement to continue talks on operating their FX markets. Now, this is interesting. We had a conversation just moments ago with Exante Data's Jens Nordvig. And Lisa asked him an important question. He was reflecting on this dollar long that's been built up over the last decade and the potential for a reversal. And the fact is that that move might be welcomed by this administration. And our reporting would, I think, to some extent speak to that.
If you have a weaker dollar, you can increase your exports in a more consumer-friendly manner. It is cheaper for other countries to export from the United States. So there is this theory that maybe this is what this administration wants, especially as news comes that they are discussing currency manipulation as part of the trade discussions. Can I just say, this feels a little bit like a Festivus-style airing of the grievances of, VAT tax and currency manipulation and chickens. I mean, it feels like that pretty much around the world. And when it comes to South Korea, they did intervene in their currency last year, late last year when the dollar was surging. Here's a question, though. What is the ultimate goal? Is it just to normalize the trade relation? At what point does it get too weak? This is going to become on your dashboard, maybe, of headlines to watch and ranges to look out for.
Yeah, this is part of our reporting, and I'd like to hear them talk about it on the record to see what the ultimate objective actually is. Now, Lisa mentioned this yesterday, that this market has potentially been reduced to just monitoring the social media account of the President of the United States, and Goldman did some research just for Lisa. President Trump likes US oil prices between $40 and $50 a barrel, according to Goldman Sachs. The firm analysed his social media account, finding he has posted nearly 900 times about oil and US energy dominance.
So this is the new model, evidently. The inference about preferences that this president has, and you mentioned earlier, John, I wonder what that inference would be for the Fed policy and what exactly triggers him to start jawboning the Fed. But this highlights two things. Number one, how important oil really is, raising questions yet again about the increase in supply from the Middle East ahead of some of these negotiations. But then there's a second question. Is this the new dashboard? You talk about economic data. Is the new dashboard Truth Social posts that you can then somehow calculate, get a sense of getting into the mind of the president and then getting ahead maybe of some of the headlines that have been jerking around this market?
I'll let others do the psychoanalysis of the president regarding
the
his
entire
social
market.
media account. It has been reduced to the entire market. I agree with you. It's been reduced to just tweets and headlines regarding trade. His point on gasoline, though, is real, and he's right. Gasoline prices have been falling, and that helps set the tone for the consumer. So let's turn to the consumer. Retail earnings ramping up with Walmart reporting on Thursday, offering another read on the US consumer. The team at Bank of America writing the following. Spending momentum remains, though it's moderating. Consumers appear to be pulling back, particularly on bigger ticket discretionary services like airline tickets and lodging. Holly O'Neill is the president of retail banking at Bank of America. I'm pleased to say she joins us now. Holly, welcome back to the programme. I want to talk a little bit about the consumer and then we can get to what you're doing operationally. But let's start with the consumer if we can. What are you noticing and how is that different to what we've seen previously over the past few years?
Well, the consumer appears to be continuing to spend. They're very healthy. And you had the headline. They spent in April at a rate of about 1%, and that's our credit and debit data. And that was just slightly cooler than they spent in March at 1.1% growth year over year. So they have momentum, but it's moderating a little bit. And I think the driver of that is that they're supported by continued wage growth. So we saw good wage growth in April, both in higher income and lower income, though it is moderating a little bit. So that theme is still healthy, but moderating.
Holly, I'm pleased you broke up the income groups because we sit on that just for a beat. The low-income group have been squeezed for a while. We've seen that in data repeatedly throughout this cycle coming out of the pandemic. Do you see any stress going up to the upper-income cohorts?
No. So the lower income household wage growth, just to give you the numbers, picked up by about 1.5% in April. And that was stronger than March. So March was 1.4%. So that wage growth in the lower income cohort increased a little bit. And I think that wage growth is continuing to support the consumer and the consumer spending. When you get deeper into the data, some of the credit data as an example, the lower income households are continuing to hold up. Overall, we've seen 30-day delinquencies come down a tad. So I think that consumer still is showing signs of good health.
This really raises a question, Holly, about how much we can really count on some of the soft data, which indicated an incredible amount of nervousness and pessimism among consumers in the United States during the month of April, in particular after April 2nd. Are you saying you're just not seeing it? That, frankly, people can go out and gripe about how concerned they are about the future of the world, but then they go out in a spending spree?
We're not seeing it. And I think we often talk internally about, you have to separate what consumers are saying versus what they're doing, what we're seeing in our data. And that data is telling us that they're continuing to spend, although it is moderating. And so we saw in April restaurants, good spending there, but we did see a dip down in airline and lodging, leisure travel a little bit. So consumers are adjusting slightly, which leads to that, the momentum is dipping just slightly, but you really do have to separate what consumers are saying in many of the confidence and sentiment numbers versus what they're doing, what we're seeing in our data, whether it's spending data, payment data, or credit data.
Holly, I want to congratulate you. You have basically just received a pretty big promotion. You're running much more of the consumer bank, and you come at a time when there's a real question around how different the scenario is in different parts of the United States, how it's not a monolithic story at all, and how different regions are feeling very different realities depending on what their local economies really depend on. How different is the scenario that you're looking at in the United States right now, depending on which region you're in?
So we obviously have across the country footprint. We have 3,700 financial centers in all of these local communities. So, our goal is to really deliver for our consumer clients, approximately 70 million of them, uniquely to what their situation is, whether that's geographic or that's individual. So, we are there to adjust and course correct based on what our clients are telling us and based on what they need.
Holly, how are the interactions changing between customers? How different are they now? And how does that change what you need out of your physical footprint?
So our strategy is all about physical footprint supported by digital. And it's really the combination of the both that I think lead to the power of how we can deliver for the consumer client. So those 3,700 financial centers in local communities, coupled with world-class digital capabilities. Those digital capabilities continue to grow, they continue to advance, and consumers love them. At the same time, it does not substitute for face-to-face interaction that we get in our financial centers when a consumer client really wants advice and guidance in their financial position. So it's the combination of the two that I think really deliver the power for our consumer clients.
Holly, how much have you been able to expand the physical footprint, in part because of the turmoil that happened? It feels like 10 years ago, but not that long ago, I guess March 2023, in terms of some of the regional banking turmoil. How much of this has just accelerated since then as you look to take market share?
So we continue to expand into new markets. We continue to build new financial centers in communities where we need them. So we will continue to advance that agenda across the country. New markets. Idaho is a recent new market that we've entered, and we've got more coming. So we will continue to expand in new markets. We'll adjust our footprint in existing markets, opening new financial centers. Over the last decade, we've opened roughly more than 200 financial centers. And as we look forward, we expect to continue to open 150 more over the next 2 to 3 years.
Holly, I was dead wrong about all this. I thought as we change these interactions, we'd end up with a smaller footprint, that it would give banks a reason to cut costs and reduce their physical footprint. Holly, why is that not happening? And is there space for that to happen in the future?
Yeah, no, you're not wrong. It has happened. If you look over the last decade, we started with 6,000 financial centers. We are down to 3,700. That may tick down slightly overall as we do things like consolidate, close 2 financial centers in a local community and open 1 new financial center. So you will continue to see at the margins some reductions, but that physical footprint, that engagement with our clients in their local community is incredibly important as a complement to the digital reach that we have with our clients.
Holly, appreciate the clarity. As always, it's good to catch up. Holly, I know there of Bank of America. Whenever we catch up with Bank of America, just a direct read on the consumer. No politics, no bias, nothing. Just this is what's happening, this is what we're seeing. And what they're seeing is still okay. Some resilience.
They didn't see any translation from that soft data into the actual behavior of consumers. This just goes to the angst that people have of what can they rely on as a sense of exactly the real-time response of consumers and of corporations.
If you are just joining us, welcome to the programme. Equity futures here near session highs, up 0.25% on the S&P. Chip makers doing nicely, and Nvidia up in the pre-market by something like 3%. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. President Trump says the luxury jet being gifted to him by Qatar's government will be used as a temporary Air Force One. Trump said it would be foolish not to accept the jet, which he says will save the U.S. hundreds of millions of dollars. The offer setting off alarm bells within the U.S. intelligence community, where gifts from foreign powers have long been viewed with suspicion. Meanwhile, Harvard has expanded its lawsuit against the Trump administration for freezing billions of dollars in federal funds. Harvard claims that federal agencies illegally halted funding because the university refused to submit to government control over its academic programs. Yesterday, the Trump administration cut another $450 million in grants to Harvard. And baseball's all-time hits leader Pete Rose has been taken off MLB's ineligible list, qualifying him for Hall of Fame induction. Rose, who died last fall, had been banned since 1989 after he was found to have placed bets on games as a player and as a manager. MLB Commissioner Rob Manfred said he met with President Trump earlier this year where the two discussed Rose's situation. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, appeasing President Trump.
I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs where no one knows where they're going to go in the globe right now.
Up next on the program, the former New York Fed President, Bill Dudley. Live from New York, you're watching Bloomberg TV. Neil Shearing, Capital Economics, with this to say. The recent climb down has left the effective US tariff on the rest of the world at around 15% versus 27% previously. Still the highest since the 1930s, unlikely to cause a global or US recession. That's the view from Neil this morning.
This is the ultimate question. Yes, the mood music has changed dramatically, but so too has the landscape versus the end of last year, and it is a vastly different and higher cost tariff regime than we had before.
Equities, off the back of all these headlines, positive for 2025. Equity futures up again this morning by 0.2%. Under surveillance this morning, appeasing President Trump.
I do think reduced tariffs gives Powell a little bit of ammunition if he has to cut rates. I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs where no one knows where they're going to go in the globe right now. It's so hard to tell where we're going to wind up as a steady state.
Here's the latest this morning. President Trump calling for the Fed to cut interest rates once again, saying it's, quote, not fair to America after a soft CPI report out just yesterday. Former New York Fed President Bill Dudley writing the following: the Fed has little choice. When it doesn't know which way the risks skew, it must wait for more information. Right now, any major move would have only a 50-50 chance of a positive outcome. Bill joins us now for more. Bill, welcome to the program, sir. Why such a negative assessment of the position that they're in right now?
Because they don't know where the tariffs are going to land, number one. And two, they don't know what the effects of the tariffs are going to be on growth versus inflation. So they're uncertain about two dimensions. So they can't really just sort of flip a coin and say, oh, we're going to worry about the growth dimension, because that could turn out to be wrong. So they have to sit and wait for more information. I mean, if you were driving a car in a thunderstorm, you wouldn't just put the car on autopilot and hope that you would get through it safely. So you pull to the side of the road until the weather cleared up, and that's what the Fed has to do. The Fed is going to be criticized for waiting. They have to wait, and because they're waiting, they're probably ultimately going to be late. But it's not the Fed's fault. I would behave exactly the same way in this set of circumstances.
But what's their definition of late? And what's your definition of late? Because he reflected on the move last summer, and he said, in some ways, we were a little late. And other people thought he was being preemptive. What's late to you?
Well, I think late is responding only after you've seen a sizable increase in the unemployment rate, because at that point, it's really hard to avert a recession. When I evaluate the risks to inflation versus the risks to growth here, I guess I worry more about the downside risks to growth. But the Fed can't put all their marbles on that side of the equation, because inflation's been running above the Fed's target for 5 years, and if they're wrong and inflation expectations get unanchored, then it's a really difficult problem getting inflation back down. So I think they have to wait. Because they wait, because they'll be forced to wait, they'll probably be late. Trump will blame the Fed for being late, but the reality is Trump created the conditions that forces the Fed to have to wait.
Bill, I'm just curious, going forward, how much you see the Fed unwilling to move, even if the unemployment rate rises by 0.5 percentage point, which is sort of the trigger that a lot of people are looking at, if you do see those inflationary pressures coming back?
Well, I think if the unemployment rate rose by, above 4.5%, that would change the Fed's calculus. They would be much more worried about the self-reinforcing deterioration in the labor market leading to a full-blown recession. So I think the unemployment rate is really the single most important indicator. If it stays around where it is today, Fed's going to just sit and wait. If the unemployment rate starts rising quickly, then the Federal Reserve will start to respond. But I think it's going to take some time. I mean, the hard data on the economy shows that the economy is still just fine. I mean, the first quarter GDP report was very misleading. misleading because it was mainly the fact that that they couldn't count inventories properly to match up with the big surge in imports.
Bill, if you were still on the Fed, and you have been on the Fed through crises and through really difficult times where the market was moving faster than the underlying economy, what data would you look at to get a real read on what was going on in the United States?
Well, I think some of the banks have actually pretty good real-time data in terms of what's happening sort of credit cards, and they're not seeing much of a slowdown at this point. Initial unemployment claims, it gives you a pretty high-frequency look at what's happening to the labor market. That doesn't show any deterioration yet of note. So I think you're looking at things that at the margin that suggests that weaknesses are starting to accumulate. Now, what's interesting is the tariffs are actually starting to bring in revenue. So fiscal policy right now is actually starting to become tighter. And I'd also look at low-income households, because I think that's where the squeeze is going to be the most significant. So if you start to see delinquency rates on subprime auto loans really start to head up, I mean, they're already high. If they start to head up even more substantially, that would be also a sign of a growing strain on the growth side.
Bill, at some point, the Fed will have to update their numbers. On March 19th, they put out these forecasts: GDP at 1.7% for 2025, PCE at 2.8, unemployment at 4.4. On June 18th, they'll have to deliver an update. When we get that update, Bill, what do you think it will look like relative to March?
I think they'll show somewhat slower growth to reflect the fact that tariffs have gone up more than they anticipated, and somewhat higher inflation to reflect the same consequence. So I think it'll be even a more pessimistic forecast in the sense that the Fed will be missing both of its dual mandate objectives by a bigger magnitude. But they still won't have clarity on what's happening to tariffs and the impact of tariffs on the economy. And so I think it's going to take a while for that to be realized. And only then will the Fed be able to act.
One missing piece: slower growth, somewhat higher inflation. What does the median dot do, Bill? Because I think that implies what their reaction function is, how they'd respond to that kind of data mix. Do you think it changes?
I think that you can make the case that the Fed starts to cut rates in September, and maybe we could still get 3 rate cuts this year, which would be consistent with the March summary of economic projections. But yeah, obviously, as time passes and the Fed doesn't act, the likelihood is the median number of rate cuts starts to come down just because there's fewer meetings left.
Bill, appreciate your time, as always, sir, and enjoy your pieces on Bloomberg.com. On Bloomberg Opinion, the former New York Fed President Bill Dudley there. How do they respond to a stagflationary mix in the forecast?
They have a couple of weeks and many more headlines to discuss before they get to some sort of response. But that is really a key question, and will only open them up, I'm sure, to more job owning from the Fed unless they cut rates by 100 basis points. This from Austin Goolsbee of the Chicago Fed this morning in another publication, saying our job is not to respond to daily market gyration. It's to be a steady hand of wait and see.
They're going to wait and see, but they've got to put some numbers on wait and see on June 18th. The next Fed meeting is not too far away. Up next, Kate Moore of Citi Wealth. We'll catch up with Chris Caso of Wolfe Research, Michael Reid of RBC Capital Markets, Lindsay Rosner of Goldman Sachs. From New York, this is Bloomberg.
There is a lot of appeal to U.S.-denominated assets still.
I don't think we're going to see this resurgence to buy America.
It's very hard to undo a decade of policy that's been very favorable for the U.S.
From a market perspective, anything that lowers that amount of uncertainty is positive.
Most of the gains are behind us because it still is very hard for the S&P to reach new highs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a year so far. It is May 14th. We are positive on the year on the S&P 500. We are positive post-April 2nd, and we have rallied by more than 18% from the April low. Your scores this morning look like this, adding some more weight to the rally. Futures higher by 0.2% on the S&P. On the Nasdaq, higher by 0.3. Your week ahead looks like this, pushing ahead to tomorrow. These are the main events. Earnings from Walmart. You'll get retail sales as well, and then an address from the Fed chair, Jay Powell. All of that through the next 24 hours. And of course, as always, one eye on the President of the United States, Donald Trump, who's just landed in Doha and had this to say. The President saying there might be news on Russia and Ukraine later on today. 24 hours ahead of a meeting that could take place over in Turkey.
Everything everywhere all at once. So here you go. Where do you focus and how do you see the potential upside? One thing that I've noticed from a lot of people is there's this real debate, given how much the market has rallied from the lows, what could send it higher, right? Given the fact that so much of the reprieve has already been baked in. And some people point to actually this. If there is some sort of deal between Russia and Ukraine, if there is progress on the geopolitical hot zones that have really been causing trouble for a lot of places, barring that, take a step back. Where do you focus, given the fact that this is a whack-a-mole market with lots of headlines to just flip your head upside down again?
On the tax bill, apparently. And I'm pleased you mentioned this. It feels like we're taking down the temperature across several dimensions. The war in Ukraine, the situation with China, access to chips, a big feature of the rally in yesterday's session.
Yeah, and this is actually really interesting, right? How much do you take away business potentially from China and then really replace it with the Middle East, given the fact that that seems to be the big promise, at least of the Riyadh trip, of the Saudi Arabian trip. Now the question goes to some of the foreign policy elsewhere. You do mention the tax bill. This is sort of, again, if your head is spinning and you're sort of like, where are we going? It's because that's basically what this market is doing. It's sort of, which is the focus of this minute? And that really is the push-pull. At what point do you get some sort of ballast from some sort of calm on trade, which, again, is disputable, at the same time that there's discussion about deficit spending that potentially could upend the bond market? So, you know, yeah, there we are.
I know this sounds really frustrating. I remember Reid of BlackRock said to me years and years ago, he said, the market can only focus on the shark closest to the boat. And the shark closest to the boat for the last several months has been trade. And after the weekend, there's a new shark. The shark is the tax bill down in Washington, D.C. And to see the market focus shift the way it has done, just in the last 24 hours alone, David Kelly at JP Morgan Asset Management came on the program. We got CPI. And we turned around to him and said, can the Fed be comfortable with this, a downside surprise on CPI? And he went straight to the tax bill and talked about a reassessment to growth and inflation 12 months, 24 months out.
Yeah, what kind of sweeteners do you get? What kind of potential increase to the deficit? Just to build on your analogy, if the market can only focus on the shark closest to the boat, what do you do if there are about 5 different sharks that are just eking out a little nose extra closer to the boat? Do you focus that much more on that one? Can you ignore the 4 other sharks that are right there?
It's
a school of sharks, and it's just sort of, you know, out there, and you have to keep track of them, and then they all kind of speak in truth.
My response back then was something like this, that if you focused on the shark closest to the boat, you miss the storm on the horizon. Is that the bond market?
Well, yeah, maybe that's the storm on the horizon, but it's also a shark. It's just a little bit further.
Managed to get gloomy for you. I don't know where this is going. Coming up on the programme, Kate Moore of Citi on why tariff de-escalation doesn't signal the all clear for risk. We'll catch up with Chris Caso of Wolfe Research as Trump opens the floodgates for AI deals, and Lindsay Rosner of Goldman Sachs as uncertainty limits portfolio allocations. We begin this hour with stocks gaining after the S&P 500 wiped out losses for 2025. Kate Moore of Citi Wealth with this to say: the market has been too fast to dismiss tariff pain. Businesses and consumers will need to share the burden of higher tariffs, and we expect both margin pressure and slower demand. Kate joins us now for more. Kate, good morning.
Hi, I did not bring my shark with me.
Good. We can move on. Your former colleague as well. Let's talk about all this volatility over the last month. I remember something you said last time we spoke. You said, I'm biased to action. I'm biased to action, but in this environment, you have to be very careful about the decisions you make. What about this new environment now?
Well, sometimes the most important action is not doing anything and actually waiting for more information if you're going to be making fundamental decisions, or if you're using fundamentals and data and strong data-based forecasts and to reallocate your money. In this case, we haven't had a significant positive change. Yes, there's a big change in terms of sentiment. There was a lot of technical pressure. We saw a lot of the fast money rush back into the market, but the earnings story hasn't changed. You know, the fact that we are in a slower growth environment than we were 3 quarters ago hasn't changed. You know, are we entering a recession? You know, who knows? I think we're in a period of slower growth. We were there before the April 2nd tariff announcements, and that we needed to kind of adjust our equity allocations for that slower growth period. And I just don't see any significant catalyst to the upside in terms of earnings growth or economic growth.
Can you share with us the adjustments you made before the April 2nd announcement? And what is defensive in 2025? Is the nature of defensive stocks different to maybe what it was years ago?
Well, okay, yes, great. Two questions there. Rotations and stuff before the April 2nd tariff announcements. There were some allocations to small cap in the portfolio that we took off. We basically said, hey, look, we don't see as much opportunity for small and medium-sized businesses in a slower growth environment, even as the labor market is reasonably strong. But inflation, we think, would continue to be a bit sticky, and we just didn't see that upside. Small cap, as you know, tends to outperform when growth accelerates. The other thing that we've been really debating, frankly, is the U.S. versus the rest of the world. And we've seen a significant amount of, investors say, hey, we don't want to own as much U.S. given the amount of volatility, the policy uncertainty, the growth uncertainty. And that's all good and fair. But the truth of the matter is some of the highest quality earnings and cash flow still exist in the U.S. And so as we think about themes and where the leadership could be in the back half of 2025 and onwards, it may be uncomfortable for some people that some of that leadership still exists in the U.S. around technology, around spending on AI infrastructure, and around these companies that have outstanding balance sheets, superior management teams, and can really weather the storm of lower economic growth.
There are a lot of things to unpack there. Just sticking on tech, since that is driving the rally this morning, certainly on the headlines coming out of Riyadh and the potential deals that are agreed upon. How much does that give you comfort to even add some of the bullish positioning in this area, given the fact that any decline in business from the likes of China could be offset by the Middle East and, frankly, elsewhere?
Yeah, so in this period we've been in for the last few months where there's been so much uncertainty and we've seen businesses kind of pause in terms of some of their spending and consumers maybe pull forward some of their demand. And, the one area that we've seen no one take their eyes off of is AI and technology, because it's existential for almost every business at this point. No one can afford to step away from their plans, their spending, their investment, their people development in this area, because if they come out of a slower period of economic growth and they're not positioned for an uptick and they're not looking competitive relative to the rest of their industry, they're going to be toast. So this is an area where I would say the spend is going to be Teflon around a lot of tech. And there are going to be other areas around extra capital expenditure or non-necessary CapEx and stuff that I will expect to be slower.
So we dealt with that shark. It's off. And I am going to bring that up again. There's another shark, which is right here, which is what John was talking about, which is the bill that they are crafting down in Washington, D.C. Right. It's still going. It's been 24 hours of discussion. How much does that raise your attention in terms of focusing more on the bond market and the potential ramifications for higher yields, deficit spending, potential steady growth, but not necessarily expansion to offset some of that increase in fiscal spend?
Yeah, look, I mean, it would be great to have some fiscal support. But by the way, we were having a bit of fiscal drag even going into this tax bill. That was 2025, just sort of the CBO estimates in general. I don't think we're going to get a huge amount of stimulus. I think that some of the stimulus that we would get for perhaps some segments of the consumer is going to be offset by a decline in spending on programs that are going to be essential for other parts of the consumer. So in general, I'm a little bit worried, frankly, about these negotiations, the impact it's going to have on growth. And as you mentioned, we're watching really the signals from the bond market very closely. But in the near term, I would say we were paying a little bit of attention 1 year on that, but most of the attention, frankly, is on whether or not there are additional trade deals struck over the next couple of weeks, or at least promises of conversations.
So you think that that's the more important driver going forward? To
yeah, I don't think people are going to be because the tax bill is complex and there are so many cross currents in it. I think they're going to be more focused on the cost side, particularly from the tariffs. In the near term, more than the tax bill.
Any thoughts on timeline? How quickly this gets done? They're very aggressive. They think they can get this done by Independence Day, before the end of the summer.
That feels ambitious. And I would suggest that, September feels more likely to me, but I'm not as much of a DC expert as some of the folks that
Does
you have
that
on
make
the
a
show.
difference as a market expert, though? Does that make a difference if it drags on into the fall?
Well, I think we're not going to have a quiet summer. Look, we have a number of deadlines around the tariff stuff that we have to pay very close attention to. There's going to be lots of conversations, headlines, announcements. I think anyone who's expecting to sort of check out and go to the beach is going to find themselves disappointed because there's going to be a lot to pay attention to. And at the same time, and this isn't really critical, we're getting some of this information on tariffs, or we go through the first 90-day window for most countries and then the next 90-day window for China. we're going to be entering into second quarter reporting season. And we know this has been a choppier period of time where there's brought forward demand and then perhaps some slower demand as people wait for clarity.
And then brought forward again.
And brought forward again.
Over the last week or so.
That's right.
So how much weight will you actually put on earnings reports? What will you look for? What have you looked for over the past few weeks?
Yeah, it's been hard because you say, wow, that was a good first quarter for most companies. And, it exceeded expectations. And you want to feel positive about that. But at the same time, I'm so focused on what companies are doing in terms of guidance. And most of them have not really significantly changed their guidance as a result of some of this tariff. They've maybe given another scenario. A few companies and a few industries, as we know, pull their guidance. But on the whole, they're just like us. They're trying to, take in new information, sometimes on a 30-second interval, and factor that into forecasts for, big spending and hiring and investment.
Just quickly, when you put this all together, it sounds like you see margin compression in the ex-tech world.
Yeah.
You see the idea of yields being sticky and stagflationary types of forces. This is a very bad mix for most assets. Is that kind of what you're expecting? Sort of flat to negative on the year?
I don't want to use the word bad. I'll say it's a more challenging mix for parts of the market. I always like to say I never want to bet against the resilience of large cap U.S. companies. They will make the changes they need to defend their margins. But I think we'd be a little bit naive to think that there's not going to be an air pocket in terms of activity or a challenge to margins, frankly, for a number of months. Perhaps it will last quarters. Does that lead to a significant earnings decline in 2025? I don't think so. But it's not going to be a smooth ride. And I think people have to be prepared to rotate into the higher quality and more sustainable earnings parts of the market, which may favor tech.
This interaction between margins and the economic slowdown, huge question from economists.
Yeah.
Will it mean losses to labour? Will it mean layoffs? We saw a little bit from Microsoft, again from Burberry this morning. I'm going to use the word we all hate on this programme, Burberry, idiosyncratic. I get that. There are other stories out there too. Are we going to see the job cuts? That's what people fear.
Well, companies haven't really cut for the most part at this point, right? They've been holding on to labor. They don't want to get into a place where they get whipsawed and then all of a sudden, as we know, the cost of bringing a new employee back on or trying to convince someone to return to the firm is incredibly expensive. So I think that they're willing to keep the labor force as is for the next quarter or two. But if margins are seriously compressed, I'd say into 2026, that's going to be a different story at a time where we might see some other headwinds.
And this is the low churn dynamic that Citi, Andrew Hoddenhorst, has talked about now for a number of months. Almost a frozen labour market. Yes, we see these big payrolls gains every month sometimes, but look at the JOLTS figures. The JOLTS figures speak to that slow churn, low churn dynamic in the labour market in America.
Is that healthy enough to keep the economy on solid footing through a tumultuous time and to keep people being able to absorb potential increases to prices? And that's the ultimate question. Or does it mask real pain that's emerging in small pockets elsewhere? And frankly, that is a conundrum.
Kate, this was great. It's good to see you again. Thanks for dropping by. We'll do it again soon. Kate Moore there of Citi Wealth. Equity futures at the moment positive by 0.2%, 1 hour and about 16 minutes away from the opening bell. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Goldman Sachs analysts say President Trump likes U.S. oil prices between $40 and $50 a barrel, judging by his social media. The firm analyzed his posts and said he tends to call for lower prices or celebrate falling prices when WTI is greater than $50. Goldman Sachs says Trump's preference for low oil prices supports their view that prices will edge lower in 2025 and 2026. Meanwhile, shares of American Eagle Outfitters down nearly 12% in the pre-market. In a preliminary earnings release, the company said it expects revenue to be down nearly 5% compared to a year ago. The retail clothing chain also pulled its guidance for the full year due to macro uncertainty. And Tesla CEO Elon Musk might get a new pay package. The board formed a special committee to explore a new package, according to the Financial Times. They say the committee will also explore alternative ways to pay Musk for his past work if Tesla fails to reinstate his record 2018 pay deal via appeal. Deliberations are still in the early stages. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the programme, the Morning Calls Plus. Chris Caso of Wolfe Research as Trump opens the floodgates for AI deals in the Middle East. Live from New York, this is Bloomberg. Here's a flavour of the equity story this morning. So far, slightly positive by 0.2% on the S&P, up by, let's call it 1/3 on the Nasdaq, adding some weight to the recent rally on both the S&P 500 and the Nasdaq 100. That Nasdaq up 24% from the lows of April. Just unreal, phenomenal rally we've seen over the past few weeks. That's the price action. Let's get you some morning calls. First up, Raymond James double downgrading United Health to market perform, saying visibility for the rest of the year is low after retracting its guidance. That stock is bouncing back by close to 3%, hammered so far this year. Your second call from Jefferies downgrading Rivian, predicting a disappointing demand outlook this year. That stock is down by 0.9%. And finally, Bank of America raising its price target on AMD to 130, saying its Saudi deal could offset China restrictions. Sticking with chips, semiconductor stocks surging after President Trump clears the way for major AI chip deals with Saudi Arabia. Chris Caso of Wolfe writing this. This announcement does nothing to change our bullish view on Nvidia or AI demand. Our concern is that government interference could potentially artificially reduce demand. Chris joins us now for more. Chris, welcome to the program, sir. Need to spend some time getting into what was actually announced yesterday, but I'd love for you to build on that. Why could government interference potentially reduce demand?
Well, and good morning. Our position is that there's plenty of demand for AI right now. Really, the constraints on, what NVIDIA can sell is constraints on the availability of power and the availability of making the chips themselves. So, in that vein, we feel that government isn't creating any new demand. What deals like the Saudi deal do would be, potentially shift the location of that demand from one region to the other. But then the other concern that we have is that, now that the AI diffusion rules that were put in place by the Biden administration are now being redone, the question is, how are they being redone? And, what it would seem like is that this will be subject to individual deals. The concern that we have is, not the deals that are being struck, and that's fine. It's the deals that won't be struck. So will there be a situation where AI chips will be used as some negotiating leverage in a trade deal, and that trade deal doesn't happen? Well, that would actually be a reduction of demand.
So, Chris, let's build on some of that, because before I came to you, I read out this call from Bank of America that they say the Saudi deal could offset China restrictions. Are you saying it's too soon to know?
Well, I guess what we're saying is that Saudi deal was going, in the absence of any regulations, that Saudi deal was going to happen. If the regulations were in place, so the Saudi deal wouldn't happen, the investment just would have been made somewhere else in one of the regions that were allowed to have chips. So again, I don't think this creates any new demand, and therefore I don't think it offsets anything. It just kind of shifts where the chips are on the table.
Chris, does it do anything for just the development of artificial intelligence and the adoption of it, of the new technologies, to see governments so intricately involved in figuring out where deals would be struck, which companies are involved, which players really do get the upper hand?
Well, and maybe put it in a little different way, what the Saudi investment is, one of the things in AI we're calling a sovereign AI. And, for example, this organization is involved in building large language models in Arabic. And obviously, most of the large language models are in, some of the more the larger languages, English and such. So you still are, and this is a big driver in AI, is that you need to have this capability in every language on the planet. And so, the Saudi investment is certainly doing that. And again, what our concern in government interference in this was, market forces doing this on their own. And, what we prefer to see is as little interference in that as possible, because the market is taking care of all demand.
All of that said, Chris, you still are very much positive on NVIDIA, and you do see this bull case simply because demand is so outstripping supply. Do you think that NVIDIA is going to be really still the clear winner, or do you see some progress being made by others? And I'm thinking not just about the likes of AMD and other U.S. companies, but also those in China.
Well, so, and I think because of the strict restrictions that were put in place just a couple of weeks ago, where NVIDIA and AMD can't sell any chips to China, there certainly is going to be an AI industry in China. It's going to be led by Huawei because they have no other choice. The issue with Huawei exporting their technology outside, well, there's two issues. One is actually the administration has said that using a Huawei chip is not permitted under the particular rules. So it makes it difficult for Huawei to sell outside of China. And the other problem is that Huawei just doesn't have access to the same process technology that NVIDIA has because of restrictions on what equipment providers can sell into China, and then Huawei can't use TSMC like NVIDIA does. So I think Huawei itself is not a threat outside of China. Where there are alternatives for customers outside of China is doing the chips on your own. And the biggest one of that is Google. Google does their own AI accelerator, and it's very good. And what we're seeing is others, Microsoft, Amazon are starting to do their own accelerator as well. I think that's NVIDIA's main competition, is the hyperscalers doing chips on their own.
Chris, just build on that. You're saying the biggest competition could be their biggest customers.
Absolutely. And, in semiconductors, there's always been a consideration, do I buy the merchant solution that's available to everyone, or do I build it on my own? Because of the enormous cost of these chips, obviously it makes a lot of sense for these guys to do it on their own. What Jensen, NVIDIA's CEO, talked about at their event last quarter was his goal is to make this a race, right? He's trying to move as fast as he can, advance the technology as quickly as possible. And his customers, if they want to do stuff on their own, they have to keep up. There's a certain amount of the market which has to go NVIDIA because of software limitations and that. And, so NVIDIA is always going to have a big place at the table. And how much share they have of AI is ultimately going to be a function of, how effectively can those customers keep up with NVIDIA's technology doing custom chips on their own.
Thought-provoking stuff, Chris. Appreciate your time, sir. Chris Caso there of Wolfe Research, just reflecting on what's been announced over the last 24 hours and giving his thoughts on the path forward.
The idea of the biggest competitors being the biggest clients, really compelling on multiple fronts. I will say, Google kind of has to. They've got an existential threat. I'm not just talking about being broken up by potential antitrust. My kids made me download ChatGPT.
How's that going?
And they say use it instead of Google because Google is old school and you really are dating yourself. And so I started just using ChatGPT, and it is, I shouldn't say this, but it's vastly superior. I mean, it really does.
It's a very different experience.
Yeah, it coagulates information in a much more cohesive way without the noise of the ads, et cetera. So it really raises this question: how does Google make itself relevant in the next phase of those kids who are all using ChatGPT?
One of the biggest headlines of the last month came from Apple. Search has peaked on Google. It was quite a big headline over the past few weeks.
Yeah, this is going to be a really important race for them to be involved in. On a broader level, though, it highlights how it gets really muddy when you try to get central planning involved with the idea of how you forecast demand and deals and all that.
There's a role for government, but I'm with you. I get uncomfortable around central planning.
I think a lot of people do.
I really do. Up next on the programme, Michael Reid of RBC Capital Markets and Lindsay Rosner of Goldman Sachs from New York City. This is Bloomberg. 60 minutes away from the opening bell. Equity futures just about positive this morning and on the year now, up by 0.08% on the S&P 500 after a tremendous rally off the low, up by more than 18% from the lows of April on a closing basis on the S&P. As of yesterday, on the Nasdaq 100, a move of more than 24%. Just unreal. This morning, we're higher by a third of 1%. Let's turn to the bond market. Your scores: 2-year, 10-year, 30-year. Have a look at 10s. Your 10-year at the moment, 447.48. The 10-year at the end of last year and the beginning of this year, let's call it 456.
Yeah, we're basically right where we were before. So essentially, nothing's changed. Again, people say don't go to the beach. Maybe we all should go to the beach because in, 3 months' time, it'll all look exactly the same, I'm sure.
Everybody who's endured the last month deserves a trip to the beach.
Amen to that.
Not sure who's banning the beach. Remember when Libby Cantrell banned the beach last year?
Yeah, and then we just heard a banning of the beach from Kate Moore. The banning of the beach has to stop.
No banning of the beaches, all right? 1 hour away from the cash open. Let's get your morning movers with Danny Berger. Hey, Danny.
Hey, John, I think if you're investing in chip makers, you can definitely take some time and go relax on the beach because these keep rallying. It's remarkable. We had a big surge yesterday, and it continues. NVIDIA up 3% in the pre-market, AMD up 4.2% after the deal signed with Saudi for a new investment pact with U.S. chip makers. Getting a lot of positive sell-side research as well. I know you're just having a conversation about this, but Bank of America also upgrading both of the chip makers, talking about multi-billion-dollar opportunities for them in Saudi. Dan Ives of Wedbush also taking the same tone, saying that it is more demand that's going to be coming for these chip makers. Now, to the downside this morning is Aurora Innovation. It is a self-driving truck technology firm. Uber heavily involved in the firm. It sold some of its tech operations to it when it comes to self-driving cars. It also took about a 23% stake in it as of the end of December. Well, Uber is now selling about $1 billion in convertible notes, and those notes can be converted for Aurora Innovation, a dilutive event. So we're seeing a big hit to shares, down 19% this morning. Also to the downside in a big way, American Eagle down 13%. It has completely scrapped its 2025 outlook. Another retailer to do this, saying it is facing macro uncertainty, also pre-announcing a very weak first quarter, heavily marred by discounts, by excess inventory, and a big write-down of that inventory. John.
Danny, thank you. The dispersion within that industry has been amazing to watch over the past month or so. We get another update from retail tomorrow. You'll get Walmart, get retail sales as well, and you'll hear from Chairman Powell too. It's quiet this morning, but a busier 24 hours coming up. Let's get to Mike McKee for more on that, our economics and policy correspondent. Good morning, Mike.
Good morning, John. Well, we don't have any indicators today to speak of. We have mortgage applications. They were up just a little bit. But tomorrow, as you say, we get retail sales at Walmart. And what will be really interesting is to see what Walmart's guidance is going forward, because retail sales will only tell us what happened last month. And there's mixed pictures coming out in terms of the analysts for that. We do have some Fed speak today. We've got 4 Fed officials talking. Chris Waller did not mention the economy. He talked about Fed research, but Phil Jefferson and Mary Daly are likely to talk about the economy and likely to use the word uncertainty. Austin Goolsbee on NPR this morning basically talking about uncertainty, saying the Fed has to be the steady hand in this situation, but nobody really knows what's going on. The market, though, doesn't have to really pay attention to the Fed, since the Fed is taking itself out of the arena for the moment. They're looking at what's going on up on Capitol Hill with the reconciliation bill. I got asked about this yesterday. What we've seen is a drop in the short end. This is the yield curve. A drop in the short end because people are thinking the Fed might have to get involved if the economy slows and they have to cut rates. But the long end going up because the reconciliation bill contains a lot of financial stimulus for 2026, 27, 28, and that could contribute to inflation in the long run. Also on the reconciliation side is the whole debate about the debt ceiling, and you can see that playing out now in the bill market. Look at the yield on the 3-month bill, which falls into that period in August when the debt ceiling would probably be hit if they don't get something passed sooner than that. It's jumped up. Uncertainty over what's going to happen there. So there is that you can see is the 1 month. That's where it was just 2 days ago, the 3-month as well. So as you can see, there's always something for the bond market to worry about, just not the Fed this week.
Mike McKee, thank you, sir. We'll come back to you in just a moment. That's a movie we've all seen way too many times over the last decade, right?
Yeah, this is the problem, is that right now it seems like whack-a-mole, and right now the focus is turning to the bond vigilantes, which once again are coming to the fore.
Michael Reid of RBC Capital Markets writes this. Here's his view on the trade deal over the last week. The trade deal with China won't get inflation back to target. Michael's with us around the table. Michael, good morning. Good
Thanks
to see
for having
you.
me.
Why aren't you encouraged? Why can't you take comfort from what was announced over the weekend?
Well, we're just going from something that was very bad to something that's now just bad. We're looking at an effective tariff rate that is about 5 times higher than it was in 2024. And the deflationary help we've been getting was coming all from the core goods space. So when you start adding tariffs onto goods, that's going to you're going to lose all that help. And you're going to lose that progress that you've been making, getting back to 2%. We saw that stall in 2024, and we don't think we're going to make much progress here in 2025.
In the pandemic, negative supply shock meets positive growth shock, positive demand shock on steroids. How different are things now, this year?
Very different. First, as you note, we don't have that positive shock coming from the stimulus. So while you did have a bit of a boost coming from consumer spending during COVID, we're not going to see that same effect here. Now, there are some positive tailwinds that could come from what we're seeing in terms of the tax cuts being pulled forward. Maybe the wealthy get a little bit of help in terms of the SALT deduction being bumped up. But when you talk about things like SNAP benefits maybe being at risk, that's going to hit the low-end consumer. Those are the folks that are really struggling now, and those are the folks that tend to spend the most money. They have the highest propensity to spend.
We've been debating how long it's going to take to see some of these things, when we start to get a definitive read, when we can actually listen to Fed officials giving us some actual constructive guidance based on their complete lack of visibility into all of this. What is your compass to understand on the margins just how stagflationary this could be, potentially how much growth could surprise to the upside? Because we keep hearing this word resilience when used with the U.S. economy.
So right now, our forecast for GDP is below trend. That is to say, we're about 1% versus what you see in terms of historic growth around 2%. And much of that comes from a drag on the consumer. We also have the impacts of trade right now. We saw that in Q1 being negative. Now, there's some mechanics, right? You're going to see maybe a boost in Q2 due to an inventory buildup. But I think further out, it really depends on the labor market. How the consumer overall reacts. And there's two very different buckets that we're seeing. We've talked about in terms of the K-shaped economy, but it's really these, those halves, the high end, the high income consumer, and those low income consumers, because inflation has impacted those groups very differently.
Well, so extrapolate that out, because we've seen this for a while. And so far, the wealthier individuals, which, as you put, might even get an additional break from some of the SALT tax deductions, have really propped up this economy en masse. And so you've seen luxury products do really well. You've seen airlines try to cater to the upper end. And you've seen a falling back of the lower income communities again and again. At what point will that matter to the overall averages? It matters very much to those communities, but it hasn't necessarily had the same ramifications in the overall general economic metrics as many people would expect.
Yeah, so I think what's at risk right now is the jobs that are tied to trade. And that's where you have a high volume of jobs at risk. So think retail trade, wholesale trade, transportation and warehousing. And those are very much correlated to the volume of goods coming in. So if you continue to see tariffs, even if we go from 20% to 10% in terms of the effective tariff rate, you're still going to see a drag on imports into the U.S. ultimately. We're not seeing it yet, but that will happen. And that's when you start to see those job losses. Businesses will have to make a decision whether or not they protect their profit margins. And labor tends to be the first to go. And so you could see a high volume of workers in those sectors lose their jobs. And I think that's when you start to see upward pressure on the unemployment rate.
And that's when the Fed conversation might shift. Be honest, did you fall asleep last week in the news conference? Did you come close?
I came close, but, Powell continues to kind of maintain a center line in terms of how he's managing both the expectations for labor and inflation. So I think the takeaway was we'll continue to wait and see.
Can he repeat the act on June 18th?
I think he's going to have to.
It gets harder with the forecasts. How are they going to change versus March?
Yeah, I think they won't change all that much, to be honest.
Interesting.
They will maybe move some of their GDP forecasts lower. I think they'll have to think about inflation. But if they're doing what we're doing, it's no longer thinking about a point forecast. It's thinking about scenarios. How is this going to play out? What are the odds you're placing on different outcomes for the economy based on what's going on with tariffs as well as fiscal policy?
We want to understand how they respond to certain scenarios, and that could be implied in the forecast. And a question we asked a little bit earlier to Bill Dudley was, how will the forecast change? And he said GDP might come down a bit, inflation might go up a bit. And then we responded and said, well, what would happen to the median dot in response to that? How will they respond to a stagflationary scenario? Because he avoided that last week. If that's asked again, if they're put on the spot, how do you think they answer that question?
I think they're going to wait and see what the data tells them. I think that's what they're going to say. What we think is going to happen is they're going to be more sympathetic to labor in the sense that when you start to see job losses, that has a significant impact on the economy, on consumer sentiment. And historically, if you look back at what the Fed has done, they tend to cut faster when the unemployment rate goes up even by 0.3. So we do think unemployment will gain in terms of their eyes if it becomes a risk that job losses are occurring.
That seems to be the bias on Wall Street, that if the labour market cracks, they'll crack too, and they'll cut rates.
That's what we heard from Bill Dudley. That right now the unemployment rate really does take precedence over the inflation rate. I guess that the logical question would be then, is it plausible for them to cut rates and see a steepening in the yield curve? Again, that long end selling off, which is what we saw last year and something that people say is probably going to be an ongoing theme.
What did Michael Reid publish last week? What was that note?
His team came out with this, which was absolutely the best email of the whole thing. Today's Fed press conference was the epitome of this could have been an email. And that email didn't even need a body, just the subject line, wait and see. By the end of that event, Powell had said wait and see 12 times and wait by itself another 13. So to me, that won the moment.
Michael said wait and see a few times as well. That's a note from a guy that almost fell asleep in the news conference, clearly. Michael, it's good to see you. Michael Reid there of RBC Capital Markets. A lot of attention is shifting now to the tax bill down in Washington, D.C. A lot of economists have done a lot of work on this. Neil Dutta of Renmark is one of them. And he said a few times now, there is a difference between removing a potential headwind and providing a tailwind. Mike McKee, I want to bring you back into the conversation. The difference between extending current law and doing something in addition to that. Just how stimulative will this tax bill be, Mike, next year and beyond?
It won't be like the Tax Cut and Jobs Act originally was, and it certainly won't be like the stimulus that we got during COVID. But it will add to consumer wealth over the next 3 years, and it's timed that way deliberately because the tax cuts that they're going to add for tips and for not paying interest on new cars, those are going to take effect next year and take effect through 2028 as long as Donald Trump's in office. So those years, that's something that will be added into what people take home. Also, the child care tax credit's going to be extended, but just for a few years. All this because they're using reconciliation and they can't have this long 10-year debt out after that. But we're going to see some short-term stimulus that might help the economy. The bond market's looking at that as perhaps a little inflationary, especially if you combine it with tariffs.
Mike McKee, thank you, sir. Good luck to the Federal Reserve, who on June 18th have to update those forecasts. Lindsay Rosner of Goldman Sachs writes this: markets have completely removed pricing in the worst-case tariff-created economic scenario. The question is if we've come too far, too fast. Lindsay's with us around the table. Lindsay, good morning.
Thank you for having me. Hi.
Some of these markets are back to where they were at the start of the year. How different is the world now? How much has the world changed now versus the start of the year?
It's changed tremendously. I think, as the prior economist just mentioned, tariffs are still net significantly higher. And so it kind of feels like a scenario where you started off with the 30% personal tax rate, it got moved to 70%, and it came back to 50%, and you think it's awesome. But don't forget, it was once at 30, and I think that's what the market seems to have lost, and it's just really excited over the past 48 hours. So I think it's going to come back to reality, sadly.
What does reality mean?
Reality means that spread should be a little bit wider, we think, and that there should be more dispersion around credit quality. That's why in our portfolios we are moving more up in quality, because we think that will protect you if we do in fact see maybe not a recession, but just softer growth. That really seems inevitable.
This builds on something that you wrote in some of your notes, saying that uncertainty for you means the bar from straying to straying from a home base allocation is higher. And it goes to the question, what is that home bias allocation? Is it to higher quality, just focusing on credit of companies that can pay it back?
Yeah, that's exactly right. It's doing that work, looking at the credit fundamentals and understanding which companies can survive in an environment where tariffs are going to be here. They are maybe not going to be as extreme as we feared, but they're here. So companies that are in the crosshairs, i.e. Consumer, retail, hotel, things that you should be concerned about around tariffs, that's stuff we want to de-emphasize in the portfolio. And home base also, just having portfolios with carry. This is an environment where you want to have carry to kind of wade all of this out.
Is high quality credit safer on some level or more defensive than duration of the U.S. government?
Well, we actually like both. Certainly there was a big debate about, has the U.S. lost their safe haven status? We do not believe that that's happened. We think duration makes sense in a portfolio because we think that the Fed will act if need be. And again, to echo the prior guess, if the Fed sees 5% unemployment, they will be cutting. What's changed, though, I think, in the probability and what the market's showing you right now is that the probability of a 200 basis point cut, because we see a really sharp, immediate recession, that's been taken off the table. And that's what you see in the forward probabilities on future interest rates.
As you know, risk can cut both ways. How much upside risk to growth does this tax bill potentially introduce?
It could, but I think we all have to lower our expectations. It's certainly not what was anticipated post-election. It's the greatest thing since sliced bread. The world is going to be a completely different place. Maybe we'll have a quantum leap in terms of economic growth. That I don't think is realistic, and I think we've all been honest with what the prospect could be. But it certainly could be helpful, for sure.
What do you think is realistic? Can we put some numbers on it?
Yeah, I think we're not going to have, I'll frame it in the terms of economic growth. We are not going to see 2% trend growth. Could we see 1? Does it not have to be 0 and certainly not negative? Yes, I'll say that. But to think that what could happen in this tax bill could then unleash animal spirits and that we move beyond a 2% trend growth, we are not seeing that at all.
Is 1% growth sufficient to keep spreads contained?
Right now, what really is being priced in both to spreads and equities is something on the order of 2% or trend growth. So back to the point of we think that things can widen from here. It's because what's being priced in feels a little too optimistic to us.
When Lisa asked you about credit, you talked about some areas, consumer-facing, retail, etc. How much dispersion are you seeing between individual credits? Because Lisa and I were talking about this earlier this morning. You see some retailers doing okay in this environment, others really struggling. How much dispersion is appearing?
Yeah, dispersion is really revealing itself. I think earnings told us a lot. Interestingly, as Mike McKee said, kind of stole my thunder, I think what'll be very interesting will be Walmart on Thursday. That is going to kick off what is happening with the consumer right now. And if you remember back, it was February 20th when Walmart last reported. They were the kind of shot across the bow that let us know, hey, something could be a little bit problematic with the consumer because of this macro uncertainty. So reading those tea leaves in earnings is really powerful, and there's a lot that you can do on the alpha side of the table to find the winners and stay away from the losers in this environment.
How much of the corporate pain is going to be absorbed by private credit markets?
Private credit markets, as we know, are growing and stand ready and open to take some of that on. So
have they already, though? Are they going to experience it in greater amounts in the public markets?
I don't know if it's a greater magnitude. I mean, there's some interesting differences between the private and public market. And one of the positive things that they say about the private market in the pitch is that there's a lot of flexibility to work with the company and the lender. And that's a relationship that can be improved and terms can be changed if needed. I don't think that the private market's underwriting is far different than what's in the public market, but there are some tools and some flexibility, and the underwriting's a little bit different. So the private market will not be immune if we have problems in credit.
Lindsay, good to see you. Clinic as always. Thanks for dropping by. Lindsay Rosner there of Goldman Sachs. Looking out for Walmart earnings tomorrow, and I think for a lot of us that is on the dashboard tomorrow morning. Walmart retail sales, and you'll hear from Chairman Powell too. Equity futures at the moment positive by 0.2% on the S&P, with an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. United Health's new CEO, Stephen Hemsley, will receive $1 million as an annual base salary plus a one-time $60 million equity award as he returns to the helm. Hemsley will also get additional personal security benefits following the December murder of the company's top insurance executive. Meanwhile, Harvard has expanded its lawsuit against the Trump administration for freezing billions of dollars in federal funds. Harvard claims that federal agencies illegally halted funding because the university refused to submit to government control over its academic programs. Yesterday, the Trump administration cut another $450 million in grants to Harvard. And at a congressional hearing today, Health and Human Services Secretary RFK Jr. plans to defend his decision to cut thousands of staff and funding at the agency. Kennedy will testify about his agency's 2026 budget request and his progress toward President Trump's goal of shrinking federal spending. That's your Bloomberg Brief. John?
Yahara, thank you. We'll catch up with Yahara again tomorrow. Up next up on the programme, we'll set you up for the day ahead and we'll touch base with Annmarie in Doha. Live from New York, this is Bloomberg. The open about 36 minutes away with equity futures positive by 0.2%. A busy 24 hours coming up. Your calendar, your trading diary looks like this. Today, the President of the United States in Doha after wrapping up his visit to Riyadh. Tomorrow, this is where it all begins. Walmart earnings, PPI, retail sales, another round of jobless claims, plus remarks from Fed Chair Jay Powell and President Trump heading to Abu Dhabi. So look out for all of that. And going into the weekend, one final data point for you. You mentioned consumer sentiment. Joining us now on the ground in Doha, AMH. Annmarie, let's get to it. The President just landing moments ago, a number of hours ago. Talk to us about this leg of the trip and what we should look out for.
Well, the president's spending some time right now, Jonathan, at the royal court meeting with the emir. We're expecting both of them to come out and sign a bilateral agreement. We understand this is economic cooperation. Potentially, this is where we're going to hear about the Boeing deal that we talked about last week, a Bloomberg News exclusive that Qatar was finalizing. Putting these finishing touches on buying at least 100 wide-body jets from Boeing, which will be a huge boost for that airliner. I actually heard today that the number is going to be higher than 100. This is a huge deal for this massive American company. So potentially we can hear that. Of course, lingering on this leg of the trip is all the fuss, really, about that Air Force One. A lot of pushback right now, Jonathan, in Washington about the security concerns if he was to accept that jet.
Looking forward to your reporting, Annmarie, on the ground, following the president. We're looking forward to the next 24 hours. Lisa, what are 24 hours coming up for this market?
Jimmy, the highlight's going to be Walmart. How are they dealing with some of their supply chains? How much are they competing on price? And how much are they going to hope to capture some of the market share at a time where that's been what they have been doing for a long time?
You're not alone. That's the main event for many. Coming up tomorrow, reacting to all of that, must watch Gene Soroka of the Port of Los Angeles, Jim Zelter of Apollo Asset Management, Michelle Meyer of the MasterCard Economics Institute, and the JP Morgan Chase CEO, Jamie Dimon from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. Reigning Roland Garros champ Carlos Alcaraz reached the quarterfinals in Rome for the first time with a 3-set win over the hard-hitting Karen Khachanov. 41 winners for the 22-year-old who closed out the victory 7-5 in the third after just under 2.5 hours. And don't forget, you can watch all the action live daily on Tennis Channel.